Welcome all of those who are joining. We will be starting in a few minutes, just waiting for everybody to roll in. Just hopefully those without power have made a plan to be able to listen. I know that some of us are going to be affected today. I know that's very unfortunate, but will have a recording which we will send around afterwards to be able, so enable you to get the gist of it. And we'll be starting in about 4 or 5 minutes as soon as we see that the majority are in. So hold on for us and we'll be starting soon. I think we'll wait a few more minutes. I see people are joining. So those of you who have joined, if you want to take a moment to get a cup of coffee or something to eat, whatever it is, just do so, and we'll start in a few minutes. We'll just no later than 5 past, just to give them a chance. But if we see the numbers ramp up, we'll start a little earlier. Jackie will just talk a little faster so we finish on time. Okay, I see people are still rolling in, but it's almost 5 past. I think we should move on. So, of course, Prof Jackie needs no introduction. I have looked through the slides, and it looks like we're very informative afternoon. So I hope you've got your coffee ready and your snacks. And Jackie, the floor is yours.
Great. Thanks very much, Stan and Danny, and good afternoon, everyone. It's great to be with you. Can you believe 13th of July into the second half of 2022? And what a tumultuous year it's been so far, and I'm sure we've got more excitement ahead of us. Hopefully we'll get some load shedding back, well, get rid of the load shedding, put it that way, soon, and we can all get used to normal lives. And apologies to those of you who might be affected by the load shedding this afternoon. Hopefully I won't be affected, but hopefully not. But yeah, at least it will be recorded, and you can always pick up the recording later. And then, of course, as always, if you have any questions, please feel free to post those questions. We're going to be talking a little bit about the 2022 filing season, and it might be useful if some of you have already had some experience with filing or trying to file. My son always makes fun of me with filing season because he's not an accountant, but he always makes sure that he files his tax return before filing season starts. I tell him it starts on the 1st of July. He files on the 24th of June. And he had great delight in telling me that this year again, he filed on the 24th of June and had his refund already before the end of June. And he was over in London on holiday at the time. I think he just did it to prove a point to me that when I said it opens on the 1st of July, just shows you I'm not always right. But I think other people have maybe haven't had as pleasurable as an experience as that. And I've seen, just watching the SAICA tax update last week, and it seems there's quite a lot of challenges. Seems like e-filing has been changed once again. So yeah, if you want to post, I don't want to get totally caught up with the filing season issues. That's very much an operational issue, but there might be some useful information that some of you can share with your colleagues here in terms of filing season and some of the challenges. But we'll get to that later. Let me not get too much ahead of myself. So what we are going to be covering this afternoon, I've got Sars documents and notices. That includes the notices around filing season. And then there was some legislative changes that came in with the Taxation Laws Amendment Act, which, as you know, was promulgated in January this year. But some of those changes taking effect during the course of this year. And then also, of course, we've got the corporate tax change. I just want to touch on that quickly as well. And then we'll talk about some tax judgments at the end. So as always, we'll run through for about an hour and 15 minutes. And so we'll take a break at about 20 past 2. I've got my alarm set just in case I get a bit carried away and I lose track of time. So it'll go off and tell me when it's 20 past 2, and we'll take a 15-minute leg stretch so you can get some more coffee and some more food if you were able to get food. I didn't get food, don't worry. When Stan said we should all go and get something to eat, I thought about it, and then I thought it's probably better if I don't take him up on that offer. But yeah, we'll have a break at 20 past 2, and then you can go and get yourselves a refreshment and a good leg stretch, and then we'll carry on until around just sort of 3:30, 3:45. We'll be done by 4, but leaving a bit of time for questions as well. Okay, so shall we just get straight into it? And I have to mention that there's always so much going on in the tax world. So I'm going to be sharing a lot of information this afternoon, but a lot of it is just to make you aware of things. I'm not going to be able to talk through absolutely everything that I show you. But of course, you know, I'll show you where to find further information if you need it. And then I'm just going to be focusing on a few of the key issues that I think are of particular interest to you. Okay, so when we look at the Sars documents and notices, I had to warn you about that before I showed you the slide. Don't worry, I'm not going to talk about everything on this slide. But I just wanted to highlight that Sars has now posted, you know, this was now back in March, that they posted the new travel allowance table in the e-logbook. We are going to talk quickly about the new interpretation note 28 dealing with home office expenses. And we'll talk about PAYE audits and employer obligations. Of course, registration of trusts I'll touch on, and I think you're all aware that all trusts have to register as taxpayers. There's an updated service charter. I'll touch on that briefly. And then Sars has made quite a lot of online facilities available, including the ability to view third-party data certificates, and updated process for dealing with admin penalties, updated process for dealing with tax directives, lodging disputes on e-filing, also an updated process. And then Sars verifications and refund delays. That was an issue that has been prevailing for quite some time, and it was an issue that was picked up on by the Tax Ombudsman, who has addressed this and provided recommendations to Sars. And well, you know, it remains to be seen if that does improve. I do see that Sars announced last week that as they process auto assessments, that refunds will be paid out within 72 hours. As I can say, I have personal testimony from my son to say he received his refund very quickly. Maybe I shouldn't mention that, but I think there are others who are still waiting, because it seems that in fact that 72 hours hasn't quite been true for all taxpayers, but no doubt those refunds should come through. Then I will talk about the new rules around regulation of tax practitioners, where Sars is tightening up on the rules around regulation. And then just to highlight that Sars does have this SMME Connect newsletter, and they have Tax Practitioner Connect newsletters that they put out virtually every month at the moment. And then a VAT Connect issue, which they updated recently. And then, of course, their notices around filing season. So yeah, we'll talk about some of these things, but not all of them. Now, I mentioned that I'll talk about interpretation note number 28. Now, this was revised, and it went through a couple of iterations even during the revision process. It was put out, then it was reissued, then it was sent for comment by the various professional bodies and stakeholders, and then the fully revised IN 28 was issued on the 4th of March. But there is an issue around the deduction of bond interest, and that's what I just wanted to highlight for you. First of all, it will be very useful for you to get hold of this interpretation note number 28, the revised version, whenever you have clients who are looking at claiming home office expenses, because this note is much more detailed than the original one, or issue 2. And also they do detail quite explicitly all of the different documentation requirements, okay, if you're claiming home office expenses, and those requirements are extensive. And so anybody who's claiming, and I think a lot of people went through this experience last year when they were submitting their 2021 tax returns, and everybody sort of, you know, happily claiming their home office expenses. And I think about 80 or 85% of those claims were denied by Sars. And so that might have put a lot of people off this year. Nonetheless, you know, there are provisions relating to the deduction of home office expenses. And so in legitimate cases, those expenses can be claimed, but of course, you've got to cross all the various hurdles of Section 23M, Section 23B, and then all, you know, the various requirements within those provisions, and then, of course, the documentation requirements of Sars. So if you are going to be dealing with somebody who's claiming home office expenses, make sure that you download this and probably provide it to the clients so that they can use that as guidance in terms of getting their documentation together, just saving a lot of time. Otherwise, you submit the thing, they call for verification, and then you go through queries and things being disallowed, and it just wastes a lot of time. So if you can just get everything together properly and get all of the necessary documentation together, it will expedite those claims and it will save a lot of wasted time. Okay, so you can also see that I've copied the link to the Sars website where they actually provide details around the claiming of home office expenses. And so if you want further information, or perhaps you want to put that into a newsletter that you can send to your clients, there's a nice, useful link there for you. Okay, so yeah, it's quite a topical thing at the moment. And just another point I should mention that they also address in this issue 3 that they hadn't dealt with previously are things like, of course, Wi-Fi. What happens with Wi-Fi? Wi-Fi, not just the monthly amount that you pay to Vodacom or whatever, or Telcom, whatever the case might be, but the actual installation of the equipment that you need to have Wi-Fi at home. And now, of course, linking to load shedding and all those things, the issue around installing solar panels on your roof and putting in inverters and things like that. So they do talk about that in issue number 3. Short answer is that it's unlikely that people would be able to claim anything if they are salary earners. If you are conducting your own trade other than remuneration, then perhaps you could claim things under Section 12B for your solar, Section 11E wear and tear allowance for your other equipment. Okay, but I don't want to spend too much time on this, but I just want to highlight that for you and point you to interpretation note number 28 if you need more information on that. Okay, then quite an important aspect that I noticed, and remember this is a mid-year update, so I'm talking about developments that have happened between January and June 22. So I know this is going back a few months and perhaps you're all aware of this, but I do think it's important to take note of this point that Sars had highlighted in the February issue of the Tax Practitioners Connect, and that deals with PAYE audits. And so coming from the perspective that Sars perhaps has conducted a PAYE audit on an employer, and they then have raised an additional assessment. So they've said the employer has not withheld the correct amount of employees tax. They raise an additional assessment and they now require this additional tax to be paid in. Now, remember that it is employees tax that we are dealing with. So what they're saying is that, as I mentioned, that the employer did not withhold the correct amount of employees tax in the first place. And now SARS wants this additional employees tax to be paid across. And so this is the point here where they say SARS may raise an additional assessment when there's this underpayment of PAYE, and then they recover the additional tax from the employer. Now, it's an interesting point because ultimately this is tax that the employee is liable for, right? It's the employee's tax. The employer has the obligation to withhold the correct amount of employees tax and pay that across to SARS on time. And then, of course, to submit the necessary EMP 201 and 501 returns. So there's actually a dual obligation. There's the ultimate responsibility to pay the tax is on the employee, but you have the withholding obligation resting on the employer. And that withholding, of course, that is what SARS is looking at the point that the employer is responsible. And so when SARS raises an additional assessment, they go to the employer to recover that tax. Now, often, what could happen if the employer is not fully aware at this point, and maybe they don't have sophisticated systems in place. So we're talking especially with your small, medium-sized businesses. So the employer pays this additional tax over to SARS. And the point is, how does the employer deal with that from that point onwards? Does the employer just record that additional tax as an additional expense of the employer? Or does the employer actually record that as an amount that has to now be recovered from the employee? And the second answer would be the correct answer, okay? And you'll see in the second bullet point, although the audit concludes, the employer is still required to calculate the shortfall and recover that from the employees. Not only must they do that, but they must also issue amended IRP5 certificates for that year and file an amended PAYE reconciliation, the EMP 501 form, supported with the amended IRP5 certificates. So you've got to go back and kind of redo that whole process using the updated information that has arisen from the payroll audit that SARS has conducted. Okay, now it's not an optional for the employer to recover the tax from the employee. The right to recover the taxes is a statutory right in terms of paragraph 5.3 of the fourth schedule. So when we look at the various obligations under the fourth schedule, as I said, paragraph 2 places the obligation on the employer to deduct or withhold the correct amount of employees' tax and pay that amount over to SARS by due date. And if they fail to correctly deduct the employees' tax from remuneration, what happens is actually the employer has a personal liability to SARS for the amount that it should have deducted. And that's why SARS initially goes after the employer to recover that additional employees' tax. You might remember seeing this in the case of BMW South Africa, which was kind of 2 years ago, where BMW had paid fees to various tax practitioners, all right, to do tax recalculation and tax equalization calculations for expatriate employees. And the case involved Sars and BMW. And some people sort of said, well, why is it, why BMW? Why don't they just go after the employees? But the point is that initially that liability is with the employer to pay that amount to Sars, and then the employer must recover that from the employee. Now, in terms of, and as I say here, this is in terms of paragraph 5.1 of the fourth schedule, and reading together with section 157 of the Tax Administration Act. Now, section 157 of the Tax Administration Act provides that a withholding agent, so this is your employer, required to withhold tax, on behalf of the employee and pay it across to Sars. The equivalent of this is also with dividends tax, right? There you've got a withholding agent where the company withholds the dividends tax on behalf of the shareholder, pays that tax across to Sars. So whatever the withholding agent might be, the withholding agent has this personal responsibility for any tax withheld and not paid to Sars, or which should have been withheld. And so if they've under-deducted the employee's tax, they remain personally liable for that additional amount of employee's tax that has to be paid over. And in subsection 2, it says an amount recovered from a withholding agent is an amount of tax paid on behalf of the taxpayer in respect of their personal liability. So it settles when Sars goes after the employer for this additional amount of employees' tax, that settles the employer's obligation to Sars. But then, of course, how do you deal with this additional tax that's been paid across to Sars? Well, as I say, the employer must recover those taxes from the employees, because if they don't, the amount that they actually pay, if you think that this additional tax you're going to just record as an additional cost to the employer, so you debit, I don't know what, additional salary cost or whatever it might be, and credit bank when you pay it across to Sars, if you do that, that expense that you have created, you can't claim as a tax deduction because it's deemed to be a penalty in terms of paragraph 5.5 of the fourth schedule. It becomes a penalty, and 23D tells us that you can't claim a deduction for penalties and interest paid to Sars. Okay, so if the employer carries that as a cost, you have to make sure that you're not then claiming that as a tax deduction. But there's other problems that come through if the employer doesn't recover that amount from the employee. And I see a question has popped up. Don't panic. I'll get to your question in a moment. So the issue is that under paragraph 28, so that's the part of the fourth schedule that tells us that, you claim a credit. So at the end of the tax year, when you work out your tax liability as an individual, you claim a credit for employees' tax paid and provisional tax paid. Now, if this additional employees' tax was paid by the employer but hasn't been recovered by the employee, well, the employee remains ultimately liable. All right, and that's come out in the case of estate late Pitchy versus Sars, a 2002 case, that the employee is still liable for that tax. Ultimately, that tax obligation rests on the employee. And so the employer really needs to go and recover that tax from the employee, and then the employer would reissue the RP5 showing the additional tax. Now, you can't issue an amended RP5 certificate if you haven't recovered that tax from the employee, because what you're showing on the RP5 certificate is the employee's tax that has been withheld from the employee. Okay, so if you haven't gone and recovered that tax from the employee, you can't show it on the RP5 as tax paid by the employee. Or if you do, you're creating another set of consequences, because now actually this is an amount that's been paid by the employer on the employee's behalf, which creates additional remuneration, and you could just end up with this ongoing spiral. Okay, so paragraph 5.4 says the employee is not entitled to an RP5 certificate until the tax is paid back to the employer. All right, because you've got to have, when you say that tax has been withheld, it must have actually been paid by the employee. And paragraph 28 says that any RP5 certificate issued in contravention of this rule will attract a further joint and several liability between the employer and employee. So as I say, you're just creating this ongoing problem situation. Okay, so just to highlight that point for you, and as I say, it's something that you just need to watch out for, because we know that Sars audits are not going to ease off anytime soon. If anything, we're going to just see more and more audit action. And it's very important that with payrolls, that you complete the whole process. And if SARS does raise an assessment for additional employees' tax paid by the employer, that you see that process through in your system. Okay, let me just have a look at this question from Anthony. SARS are still plonking a recon assessment amount on PAYE statements without notice, explanation, or audit. Okay, I don't know specifically what that relates to, but of course, whenever SARS raises an assessment or raises an amount of tax owing, you have a right as a taxpayer to request reasons for that. So I would really suggest that you go the specific route of requesting reasons. I know you say that despite request, no reasons are obtainable, but they have to be obtainable in terms of the Tax Administration Act dispute resolution process and the rules that were published back in 2014, is that the taxpayer has rights to reasons. And you can actually get more information about that if you have a look at the Tax Ombuds website as well. They also talk a lot about the dispute resolution process and the right to reasons. Okay, so yeah, don't let that one go. Make sure that you get the reasons that you are eligible for. Okay, let me just close that. Okay, so that's the issue around employees' tax. And then changing a company's year end. Much later on, if you're still awake and you're still with me and you haven't lost your power because of load shedding, when I talk about cases towards the end of the webinar, I'll talk about the Lavinia case, which at that stage you might need a glass of wine, but it's a lovely wine estate down in the Western Cape, that had a dispute with SARS around changing of a year end. Now, that case actually doesn't really tell us a whole lot right now, because it was a case that dealt with changing a company year end under the old Companies Act and under the old processes that SARS used to follow. Since then, things have changed. But what I do just want to highlight is that I think as a result of the judgment in that case, it certainly has raised this issue around changing a company's year end and what is the process and how do we actually do this? What are the rules? Now, you can get information here on the SARS website. If you go to, I've given you the actual link there, SARS, types of tax, corporate, keeping my business details up to date. Okay, now it gets problematic on Zoom. If I start clicking through onto these links, then you can't see what I'm doing. So I'm just going to leave it there. You can click on that and have a look on your browser, and you'll see that they give the information. But the key thing is that if a company changes its year end, then obviously you've got to do that through CPC, and then you need to also, and this is a point that's not made on the SARS sort of step-by-step process, is that you must also actually, as the taxpayer, go in and change the year end on the RAV01 form. So I've just added this onto the slide. So you can also get information on how to do this. The SARS has a guide on how to complete the registration amendments and verification form. That's the RAV01 form, how to do that. And so you can click on this guide or copy this and paste it into your browser to see how to actually do it. But you actually go in on the RAV01 form and you literally change your year end there. So if your year end was, let's say, June, and now you decide to change your year end to September, in terms of the current Companies Act legislation, you can't have a year longer than 15 months, although it seems that SARS does, and CPC, sorry, does accept longer periods. But strictly speaking, it shouldn't be more than 15 months if you do push your year end out. But if you were going to do that, then you go into your RAV01 form and you literally change it there from June to September, and then SARS will verify that with CPC, and they then approve it and notify the company's representative that the year end has been approved. Of course, another step that has to happen, and this was picked up by the guys at SAICA, and that is that SARS must also be notified to change your provisional tax dates. Because, look, your first provisional tax date might well have passed and you submitted your provisional tax return. Maybe it has, maybe it hasn't, okay? But if you're pushing out your year end, your second provisional certainly wouldn't have come around yet. And if you don't change the provisional tax dates, if you don't ask SARS to change those on their system, then in my example, when they get to the end of June, they're looking for your second provisional return, you thinking you're only going to submit it end of September, your new year end. And in the meantime, Sars is saying that, you've failed to submit a second provisional return. And of course, they're looking at late payment of provisional tax penalties and interest. Okay, so it's really important to ask Sars to change the provisional tax dates as well. Okay, so it's a kind of a combined process with you and Sars. And it might well be that you end up having to set up a meeting and actually go and sort of interface with Sars to make sure that this year end is correctly reflecting on the system and that your provisional tax dates have been moved out. Okay. Then another point I just wanted to highlight, and in this current climate of interest rates changing quite regularly, is your Sars interest rates. Now, on your slides initially, when I sent this out, I just had the standard format, table 1, 2, and 3. But I thought it might just be interesting as I was going through these slides this morning, thinking that it would be useful just to recap and link with the SARB repo rate. So that's the South African Reserve Bank repo rate. And obviously, what is driving the changes in the Sars interest rates is the fact that the Reserve Bank repo rate is changing. The monetary policy of the Reserve Bank sits, and every now and again they decide, and currently we're in this economic climate, not just here, but internationally, right, of increasing inflation. And so we see these interest rates going up. I mean, this is after we were quite spoiled for a few years where the rates just didn't change. And that's why I want to highlight this for you, is because especially if we look at table 3, the official rate of interest used for low interest loans, section 7C, which is everybody's big nightmare, right? Loans to trusts, loans to companies owned by trusts, etc., creating that deemed donation. And we work out the amount of the deemed donation by saying, what is the interest that would have been charged had you used the Sars official rate, less interest actually charged on that loan, or in the case of preference shares, less the preference share dividends actually paid. So this amount, if we see the interest rates going up and you've got an interest-free loan, then it stands to reason that the amount of your deemed donation, or also deemed dividend, of course, for section 64E, that deemed dividend and deemed donation is going to go up as well. Okay, so just be aware of that if you are doing these calculations over the whole year, you're going to be saying for this loan, trying to have a sip of water, hold on. For this loan that was in existence, let's say for the whole year up to the end of February 2022, then you need to be obviously using whatever rate was applicable over the course of the year. So basically taking 4.75 up to the end of January, and then from the 1st of February, it was 5. And then, of course, now in the current year of assessment from the 1st of April, 5.25, from the 1st of June, 5.75. Okay, so just be very careful that you are using the right interest rates when you're doing those calculations for your deemed donations and deemed dividends. Table 1 and 2 is talking about interest paid to Sars and interest paid by Sars. Okay, and as you know, there's always a 4% differential between these two rates. So when we look at these rates, interest paid to Sars, that's interest obviously on outstanding tax. And the issue there is that if you end up paying interest to Sars, you don't get any tax deduction for that interest, right? It's similar to what I mentioned earlier about the penalties. So you don't get any tax deduction for interest or penalties paid to Sars. But if interest is paid to you by Sars, they're going to use this lower rate over here. And then, of course, remember that that does come into your gross income. But the timing is only when the interest is actually paid by Sars. So there's a bit of a timing issue there. Okay, so just to be aware of that. So we saw the latest change 19th of May. And as we go forward, it is looking as if we might well see another increase in the interest rate going forward. So just be aware, especially with the deemed donation and deemed dividends, that you're using the correct interest rates. Okay. Yeah, so George, yes, as I said just now that I went through the slides this morning and I just decided to add in a bit of extra info. So I will send these updated slides through to Danny and Stan as soon as I finish the webinar. and then we'll send them out to you. Okay, so I thought, yeah, it's always a bit of a thing when you send the slides through before, and then of course, you know, they always say that the best editing happens after the book has been published, right? And the best editing on slides always happens when you've already sent the presentation through. So apologies for that, but we'll send an updated set of slides. Okay, cool. Thanks. Rightio. And then onto the new Sars service charter. Well, I got quite excited when I saw that Sars had released a new service charter, because it's something that people have been calling for quite some time. And lo and behold, there it was released, and we were told it applies with effect on the 1st of April 2022. But I was quite disappointed when I went in and had a look at it, because actually, yeah, in fact, I do find it quite curious that the service charter in many respects just reiterates what the turnaround times are as stated in the tax legislation. So, you know, the time to respond to a letter of objection, the time to respond to a request for reasons, and all of those good things. And what makes it even more concerning to me, and other people have viewed this point as well, is that, you know, if they have a deadline imposed by legislation, like they've got to respond to you within, you know, 40 days, whatever the case might be, then they will say in the service charter, they will endeavor to do that in perhaps 80% of the cases. And I think that's quite concerning, because taxpayers are not given that latitude. You know, we're not told we can get it 80% right. You've got to get it 100% right. Otherwise, you face all sorts of penalties, or you face the risk of not having your objection attended to, etc. So I'm not going to go through the whole service charter. It's pretty much as it was before, except that, you know, we've now seen these things being introduced where Sars says that, you know, if they get it 80 to 85% right, they feel that they've met their targets. But I have given you the link there to go in, and I think it is important to just have a look and see what the service charter says. But it's not that Sars is committing to do anything other than what they are required to do in terms of the legislation, in my view. That's how I see it. All right. What Sars has been doing, obviously on an ongoing basis, is updating their online functionality. And I just wanted to bring to your attention that they have provided information about a nice link to register a new trust. And then they've how to verify your tax compliance status, and submitting supporting documents, etc., etc. So there's a whole lot of additional information. If you want to see any of this, in fact, and apologies here, this again, I added this a little bit in here as well, but it'll be in the updated slides that I send you, is as of this morning, and I see, and I think it's especially with the strike that's going on at Sars, I think you've probably seen that about 18 branches have had to shut down because of the strike action that's happening there. And so Sars, so on their What's New website, they've really been pushing the issue around what you can access electronically and online to try and get people to make use of the online functionality. And so they've been putting out just a lot of information about this. And so as of today, this is what I picked up. Some of this is a bit of a repeat of what I had on the previous slide, but I thought I'll just put out all the new stuff. So if you just go onto the Sars What's New, okay, and literally you just go onto the homepage that comes up when you go into sars.gov.za. And you see what comes up there under What's New. Click there, scroll down past all of the explanations about the strike action, and then you will see that they have all of these links on different things that you can obtain. And it is quite useful to know the things that are available there. It just might save you a little bit of time in terms of looking for stuff. Okay, I'm going to talk in a moment about auto-assessment. So I think that's quite a topical issue. Can the taxpayer go on strike? Well, you know, the answer is no. Because, you know, as we saw, Sars has said in their service charter, they only have to get it right 80 or 85% of the time, but the taxpayer's got to get it right 100% of the time, right? Yeah, it's quite concerning. I have heard some of the interviews with some of the union people around the Sars strike, and it is quite concerning. I don't. Hopefully, it's not going to completely undermine the filing season. But fortunately, I think with the e-filing process, hopefully a lot of stuff is working, that you're not having to phone the call center, because I think with a strike action, it could be that having to get hold of the call center and getting people to help you might become quite difficult. But let's hope that all this online functionality actually works. Okay, and then part of that also with the online functionality is viewing third-party data. So obviously when you call up your tax return, and you've got the third-party data reflected there, if you can't understand where some of the information comes from, you can actually click on this link and have a look at the third-party returns and files. And they've got a guide here, how to view submitted third-party returns or files. And that also will be useful when you get your auto assessment. And I think with the auto assessments, they are actually providing you with a little link to see the third-party data. So if you're getting a surprise that there's interest there, you never knew you had that investment. And I've heard of this happening a few times actually, that people have interest popping up on their tax return and they're like, I don't know what this investment is. I don't ever remember making that investment. So then you can actually go in and have a look at the third-party data to see where this money came from. Maybe somebody gave you some money, who knows? Or maybe you just made an investment a few years ago and you forgot. Or it could be a mistake, okay? And in which case, you got to go back to the source of the data, which is the financial service provider, and they've got to make the correction. All right, so this is quite important to be able to see this, and hopefully everything looks okay, but when you have a problem, you have to sort it out. As I say, I'm still coming to the filing season discussion just now. Before we get there, I just wanted to highlight 3 new interpretation notes. They do have fairly limited application, I think, so I'm not talking about them specifically, but the one talks about the deduction of medical lump sum payments. This is when a company pays medical contributions in a form of a lump sum. And generally speaking, what happens there is that of course, let's say that the company has 100 employees and they pay a medical contribution of 1,000 Rand. Okay, you would simply then spread that contribution between the number of employees to say how much was paid for each employee. And the interpretation note just goes in to explain how that happens. And then interpretation note 120 deals with the prohibition of deductions on certain intellectual property. And then interpretation note 119 talks about deductions in respect of improvements to land and buildings not owned by a taxpayer. So this deals with the Section 12N allowance. So for example, if you've got land or buildings that you are leasing from the government and then you make improvements, normally you would have to be owning that property, but 12N makes a special provision that even if you don't own it, in certain circumstances, you can claim the deduction. So that just goes into further detail about how that provision actually works. All right, and then some updated Sars guides. This I think is just useful, and again, it's a good source of information, especially when you've got the Income Tax Act, right? And that's what I always keep. I've got it here under my left hand, even as I'm talking to you. But of course, it's also useful to have additional information. And so these Sars guides, I think, are pretty useful with the fringe benefits, allowances. This guide in respect of allowances gives a good explanation in distinguishing the difference between advances, reimbursements, and allowances, okay, which might have different tax treatments. And then, of course, a really important one is this guide for provisional tax as we start heading into the provisional tax season. And I say provisional tax season because, of course, with February year ends, the first provisional tax return due end of August. And then, of course, the second end of February next year. Yes, of course, companies might have different year ends, but July, August is traditionally when people really start thinking about provisional tax, and they have updated this guide for 2023. So it is the updated provisional tax guide. Then they've got the comprehensive guide to the income tax return for trusts. And I think anybody who is going to be completing a tax return for a trust needs to be familiar with this guide. And they also, of course, have the comprehensive guide to the ITR 12 for individuals, the income tax return, then another guide for deceased and insolvent estates. Okay, so those are very useful if you are doing returns, if you're in compliance doing tax returns for these particular types of taxpayers. And then this comprehensive guide to dividends tax, which is quite technical. It deals with some practical aspects as well. but it really goes into the technicalities of what is a dividend, what is a return of capital, and all of those good things. It's really great material for academics like myself when we are putting notes together for students, but I'm not sure how useful it is for the average person, but it's certainly there if you do need additional guidance on dividends tax. And also if you want information around things like getting a refund of dividends tax, okay, and things like complexities like that, you'll find that will be addressed in that guide. Okay. Now, I get on to two main topics that we're going to be talking about. The one is this change in the rules around the regulation of tax practitioners, and then after that, we'll come to the 2022 filing season. Okay, so what's happened here is that Sars has updated their requirements around the regulation of tax practitioners. Now, obviously, we have the requirements in the Tax Administration Act, Section 240, tells us that a person who provides tax advice or submits tax returns for reward is required to register as a tax practitioner, all right, unless you're working for somebody else that is the tax practitioner and you're under their supervision and control, etc. But otherwise, if you are doing tax compliance or advisory work for reward, you need to be registered. It's a legal requirement, and I'm sure I don't need to tell any of you that. I'm sure you're all well aware of that. Sorry, let me just get rid of these calendar entries that are popping up on my screen here. Hold on a sec. Let's just get rid of that. It's the joy of having these things to remind us of things that I don't need to be reminded about. Okay, anyway, so Section 240, the requirement to register as a tax practitioner. And as always happens with the Tax Administration Act, when you're required to register, you have to do so within 21 days of becoming liable to register. And I'm sure that all of you that I'm talking to today are probably registered tax practitioners. But some of you might be thinking about becoming registered. Maybe you're just starting out and you're starting to do this work and you realize that you need to actually register. But I think most of you are probably already registered. So as tax practitioners, that's one level of registration. But then, as you know, as a tax practitioner, you also have to belong to a recognized controlling body, or the RCB. And RCB itself has to be recognized by Sars. And so Section 240A sets out the criteria that have to be met by a professional body in order to be recognized by Sars. And in fact, on the Sars system, they actually have a list of the RCBs that have been recognized by them. But certainly, if you're a member of SAICA, SAIT, SAIPA, what else? The Chartered Institute of Secretaries and so on, those have all been recognized by Sars as RCBs. Okay, so you register as a tax practitioner and then you have to be a member of an RCB, because the RCB provides the role of oversight. And you'll see just now that SARS requires the RCB to report back to them on certain oversight measures that they have to undertake. Okay, so if we just have a look here, what's happening here going forward. So this actually came into effect from the 1st of June 2022. And so they've got some requirements for existing tax practitioners, but it's actually new people coming into the system that are going to be most affected by these new requirements, because a person who's going to look at registering on or after 1 June 2022 has to meet certain education requirements, which are a little bit different to what they were before. Now, if you're a chartered accountant or a member of SAIPA, SAIT, etc., don't worry about it. You're not going to be deregistered. This is going forward what the requirements are going to be. And you'll see here that the person who wants to come in as a new tax practitioner has to have one of these levels of experience and qualification. So starting at the bottom, the minimum level would be an NQF level 4, okay, plus 10 years work experience. It used to be 5 years. If you were coming in with NQF level 4, that's grade 12, basically. If you're coming in with a grade 12 matric, you must also have, going forward, if you're a new registration, you must have 10 years tax working experience. It used to be 5. And then as you go post-matric, this is how the NQF levels work: 1 year post-matric, 2 years post-matric. NQF level 7 would be your bachelor's level of BCom kind of thing. NQF level 8 would be your CTA or postgraduate diploma, NQF level 9 or honors, all right? NQF level 9 would be master's, NQF level 10 would be PhD. Okay, so that's the levels we're talking about here. So we're talking about somebody coming in with a grade 12 or a 1 year postgrad or post school. Then they must have at least 4 years tax working experience. That's a new recognition over here. And then if they're coming in at NQF level 6, which is something equivalent to 2 years post matric, okay? But then within their studies, like if they've done a postgraduate diploma, certificate, they must have at least one accounting module and one tax module. So that's kind of like accounting 1 and tax, but tax is usually covered at second year level minimum at university. So they would have to have one of those, one of each, okay? Plus at least 1 year's tax working experience. But notice here it says NQF level 6 and above. So even if you're coming in, if you've just recently qualified as a chartered accountant, having done your 3-year degree plus your CTA, you coming in at NQF level 8, actually, but you still have to have at least 1 year's tax working experience, okay, in order to register as a tax practitioner, which is, yeah, I mean, it might sound like a bit of an onerous one, but if you've had your experience within your training contract, I'm sure that would be sufficient. But then you also have to, you'll see on point B, you've got to also complete the Sars readiness program. Okay, and then they're going to assess you. You've got to attend and pass the assessment. And you might have seen, if you're a member of SICA, you would have, and I guess the other professional bodies have been doing this as well, is that they've recently put out a link where you can actually pick up all of these videos. I think Sars has put out something like 8 videos, and you can go and watch the videos. Quite nice to sort of get back up to steam with everything. And then there's the assessment. Now, if you want to come in and register as a new tax practitioner, you've got to pass the assessment. But anybody can watch these videos just for fun. Okay, so I don't know if the rest of your family would see it as fun, but, but certainly it's something that you can do. And, you know, it might just be useful in terms of seeing some additional perspective on some of these fundamental issues. Notice here that, just going back to point A, the tax working experience must be verifiable by the employers or clients. So you almost need like a portfolio of evidence in order to register. And they must be tax compliant, with tax compliance status, and they must have submitted to their Rcb an independently verified criminal-free tax certificate, criminal-free certificate as required under Section 240, subsection 3. Like a SAPS police clearance certificate. But they say, for example, because there are other private bodies that provide similar criminal-free certificates. Okay, great. Must an existing tax practitioner? I'm going to come to existing in a moment, so hold on to that thought and I will answer it. Okay, so these are these new registrations. Once the individual is registered, an annual confirmation is required. Now, when this annual, what they talk about the annual confirmation, and you'll see this coming through with existing tax practitioners as well. This would be your Rcb would actually ask you to complete an annual declaration, right? And on that annual declaration, you would confirm, if it is true, you would confirm that your criminal-free status remains unchanged. So that's the annual confirmation. You would do that annual confirmation yourself. And that's done on a year-by-year basis. And then every 5 years, there must be a sworn affidavit indicating that the tax practitioner has remained criminal-free, and that has to be produced to the Rcb. All right, so remember that you have to register with your Rcb and then register with Sars. So the Rcb would verify all of the qualifications and work experience, and obviously then you would have to, on the Sars system, you would have to pass these assessments. These assessments are administered by Sars. I'm not aware exactly how they run, but that would remain to be seen. Now, for tax practitioners registered before, don't worry, you're not going to have to now suddenly pass a Sars assessment. You are in the system, you are registered, you met the requirements, and on an ongoing basis, you meet the requirements of your recognized controlling body. Okay, so I'll come to Cpd requirements in a moment. The Rcb is required to check that all of their tax practitioners are criminal-free. Okay, so they have to ask their tax practitioners to submit their annual declaration stating that they remain criminal-free. okay, and then every 5 years a sworn affidavit. But a sworn affidavit doesn't mean you have to go and get the police clearance certificate, all right? A sworn affidavit is literally to stand there and undertake a sworn affidavit before a commissioner of oaths, confirming that you are criminal free. So that would be on the declaration that the tax practitioner makes to the RCB. Okay, and then going forward, the RCBs have to ensure that all of their tax practitioner members meet certain requirements. Okay, and this, now we get to CPD. Okay, so previously, the CPD requirement for a tax practitioner, now, of course, to be you might have other CPD requirements in terms of CIPA, whatever the case might be. But to be a tax practitioner, the minimum requirements used to be 15 tax-related hours, of which 60% were verifiable. So in other words, 9 hours of verifiable CPD per year, 6 hours of non-verifiable. Now that requirement applied up until the end of May. And then from the 1st of June, they've ramped that up to say, actually now it's a total of 18 hours verifiable. Okay, so it's double the amount of verifiable hours. Okay, but it's actually only 3 more hours. It's just that it's now 18 hours of verifiable, and that has to consist of 10 straight tax hours. So things like watching this webinar would count for that. Okay. And then 2 ethics hours, tax ethics, well, ethics, okay. I mean, CICA has ethics, CPD, things that you can participate in, as do all of the other professional bodies as well. So you'd have to verify that you've done 2 hours of ethics CPD, and then 6 hours relating to the service provided. Now these things haven't been specifically clarified, but just reading the ordinary English meaning of that would indicate that if, for example, you were practicing in international tax, then you could do 6 hours in that field. If you're practicing in VAT, 6 hours in that. If you're just a general, I say just that, okay, don't take that. If you are a general tax practitioner covering all aspects, then of course the 6 hours could relate, across the board, because you're dealing with all aspects of tax. If you were in something like dispute resolution, it would be in that area. Okay, but if you are a tax practitioner who attends to all aspects of tax, then obviously that 6 hours is going to be sort of pertaining to all aspects of tax. Okay, so that's your 18 hours. That's how it's made up. Okay, and then for newly registered tax practitioners, prorated. So if they come in half the way through the year, they only have to do 9 hours. If they come in at the beginning of the year, they have to do 18 hours. Okay, now the other point is that, as I say, the old requirements applied up to the end of May. These new requirements apply from the 1st of June. Now, you work out your total CPD on a calendar year basis, right? So by the end of December, you must have met the various requirements. And to work out what are your requirements now, so if we take 15 tax-related hours times 60%, so under the old requirements, there was 9 hours of verifiable and 6 hours non-verifiable. Now, if you had 15 hours of verifiable, okay, that's great. So 15 hours in total, of which at least 60% must be verifiable. So if we prorate that, if we take 15 divided by 12 times 5, so up to the end of May, that would be 6.25 hours under the old rules, of which 60% was verifiable. Then the new rules, 18 hours divided by 12 times by 7 now, okay, from the 1st of June to the end of December, it's effectively 10.5. So it's 16.75 hours, if you want to be specific, must be done by the end of the year based on these rules. Okay, it's because we prorate the old rules up to the end of May, and then the new rules from the 1st of June through to the end of December. So the RCBs have to check that their members are meeting these CPD requirements. And as you know, the professional bodies are very strict with this. They are required to verify by Sars. Now, they're required to verify at least 20% of the members' CPD records every year. And the requirement is also there that RCBs must retain records of the verified compliance status of its tax practitioner members. And that's that the record keeping requirement always 5 years, right? Notice also tax practitioners must also retain their CPD records, their competency certificates for 5 years. And when I mentioned this in a previous webinar that I did last month, immediately I had people coming back to me saying that, they threw all this stuff away. They don't have it. What are they supposed to do? Well, look, I mean, if it's gone, it's gone. But going forward, and as much as you can, you should try and keep these things for at least 5 years, just to make sure you don't run into any problems. Okay, remember the onus is always on, in this case, the tax practitioner. So if SARS comes back and challenges you, or your RCB comes back and challenges you that you haven't done the necessary CPD, you want to be able to produce the required competency certificates to say that actually, yes, I have. Look, here's this 1 hour I did there, 2 hours I did there, etc. Okay, and this is this issue around the prorating that I was talking about. Now, let me just go to the questions. You would like to answer this question live. Okay, done. Must an existing tax practitioner obtain police clearance? No. Okay, you don't. It's just that on an annual basis, you must do the declaration to say that you're criminal free, and every 5 years you need to do the sworn affidavit. 6 hours only deal with tax and not accounting. Yeah, because this really is looking at your tax competency as a tax practitioner. Okay. All right, now, and this continues now when I was talking about the CPDs, what CPDs have to do. It links back to this, okay? So not CPDs, RCBs, what RCBs have to do. All right, so it links to that. So RCBs also have to keep records of dismissed members due to gross misconduct, if any are dismissed. And then they're required to also notify SARS when they've dismissed a member. And that enables a centralized register to be held by SARS. And then RCBs must also verify the tax compliance status of tax practitioners at least once a year. And it says, basically indicates that they must verify the tax compliance status of all their tax practitioners at least once a year. And they would have to confirm to SARS that they have actually done this. Okay. Now, this review of the RCBs, this is now point number 3 in terms of this statement that was issued by SARS, okay? So point number 1 was the new tax practitioners. Point number 2 was the CPD requirements and what the RCBs have to do. And then this is now talking about how SARS is going to review the RCBs going forward. Okay, so SARS will then undertake an annual review of RCBs from the 1st of July 2022. Basically, once a year, they're going to look at each of the RCBs. There are only about 6, I think, 6 or 7 that have been recognized by SARS. So it's not as onerous as it sounds. And remember, what they're looking at is whether the RCBs have kept these records of dismissed members, that they're checking the tax compliance of their tax practitioner members, and that they're checking the CPD compliance of their members. Okay, and then SARS will check that that has actually been done. And if an RCB fails to meet the criteria and they fail to take remedial action, then they can be de-recognized by SARS, which will be a problem because it means all their members would then not be recognized by SARS, because your tax practitioner has to be a member of a recognized RCB. Fortunately, I think, the ones that have been recognized by SARS have sufficient gravitas and they're big enough and they have sufficient systems and so on. I think that I don't think you're going to find that there's a risk at this stage, but of course it's a reality that the RCBs must remain compliant in order to remain recognized by SARS. And with the tax practitioner status, now here we get to the actual tax practitioner. Now this again is not new. This is in the legislation. And this is in terms of section 240 subsection 3, which tells us that a person is not allowed to register as a tax practitioner, or if they are already registered, they face being deregistered if they become non-compliant. Okay, so this is just reiterating that if a tax practitioner fails to meet these criteria, SARS may deregister. And they can deregister either with immediate effect if the non-compliance falls under section 243A to C. I'll show you these provisions in a moment. Or there can be a warning given, and if the person doesn't take the necessary remedial action to fix up their non-compliance, then they can be deregistered. So this is a kind of a delayed providing for intervention situation if it's a non-compliance under section 243D. Okay. Sorry, I thought I had answered that. Let me just get rid of that question there. Okay, so let's go on and have a look at the deregistration of tax practitioners. Also, RCBs, I mentioned, can also be derecognized. In both cases, you can ask SARS to review their decision if you have fixed your non-compliance, all right? Now, if we look at what I said, so I said a tax practitioner can be deregistered with immediate effect if their non-compliance, their non-eligibility to be a tax practitioner falls into section 243A to C. And that's these provisions over here, all right? And A is that in the last 5 years, they've been removed by a related profession for serious misconduct, or during the preceding 5 years, they've been convicted of theft, fraud, forgery, etc., for which they've been there's been a fine, or they've been sentenced to a period of imprisonment without the option of a fine, or to a fine exceeding the amount prescribed in the Adjustment of Fines Act, or if during the last 5 years they've been convicted of a serious tax offence. Now, a serious tax offence is defined in the Tax Administration Act, Section 1, and perhaps I should just read to you what that definition actually says. So a serious tax offence means a tax offence for which a person may be liable on conviction to imprisonment for a period exceeding 2 years, so it's similar to what we saw over here, or to a fine exceeding the equivalent amount under the Adjustment of Fines Act. Okay, so that would be a serious offence. It's kind of an offence that's going to take you to jail or criminal action. Okay, so if you fall into any of those kind of serious misconduct, serious non-compliance issues, you could be deregistered with immediate effect. On the other hand, if you fall into subsection D, and that is where during the last 12 months, you've not been tax compliant. So if SARS was going to go and check your tax compliance status on an ongoing basis, and they find for 6 out of the last 12 months, whenever this might happen, this is a rolling period. It's not per year of assessment or anything like that. It's literally like if I had to look today and I look back over the last 12 months, has this person been non-compliant for at least 6 months out of those 12 months? And they failed to demonstrate that they've been compliant, or they failed to remedy the compliance within the period specified in a notice by SARS, then SARS would go ahead and deregister that person. Now, when we talk about tax compliant to the extent referred to in section 256.3, and I think you're probably aware of this, well, what does it mean to be tax compliant? And there's 3 issues. It's registration, debt, and returns. Okay, so you must be registered for everything that you're supposed to be registered for. You must have no outstanding tax debt other than tax debt that you've entered into some kind of payment arrangement or compromise with SARS, or you've applied for a suspension of payment if you are undertaking a dispute with SARS. Okay, or it's an amount that doesn't exceed 100 Rand. That's the amount referred to in section 169.4. Okay, so that's your debt. No outstanding tax debt means debt that's gone beyond the due date for payment, right? It then becomes outstanding. And the third one is no outstanding returns unless you've made an arrangement. So any of those things, and I think you're aware of this, if you're outstanding on any of those things, you would show as non-compliant. Okay, so what this is saying, just going back this point here, is that if you're non-compliant for at least 6 of the last 12 months, then SARS would notify you and give you a period in which to correct your non-compliance. And if you fail to do so, they could then deregister you as a tax practitioner. Okay, let me see here. I've got 2 things popping up here. Good, Stan, provide certificates. Yay. Well done. That's great. Okay, so you can go back 5 years. If you've lost them, ask Stan. He'll find them for you. And then, do these obligations also hold for individuals that file their own tax returns? Well, look, these obligations, okay, let's just break this down. So when we look at this tax compliance status. That applies to everybody, okay? As you know, if you want to get your tax compliance status, that's how Sars measures it. They say, are you tax compliant in terms of these requirements? That's how we establish whether a person has tax compliance status. When we're looking at a tax practitioner is somebody who completes returns for others or provides tax advice for others for reward, okay, apart from specific exclusions like employees of firms and so on. Okay, so when you're looking at a tax practitioner, this is the tax practitioner's own tax situation. Okay, so you're registered because you're providing tax advice or you're completing tax returns for others. But in order to be registered, your own personal tax situation must be compliant. Does that make sense? Okay. Right. And then to kind of round off on this, Sars has put together a draft interpretation note to explain how it works when they are going to deregister somebody. All right, persons who are not eligible to register because of that tax compliance or the serious criminal issue, or somebody who is registered, but then they become non-compliant, or they have been non-compliant and they haven't rectified it. And so this draft interpretation note just explains how that actually works. And I think the key issues, when I say here, see examples, as I say, I'm not going to click through because it just causes a bit of disruption to the whole webinar. But what that draft interpretation note, and quite shortly, I'm sure they'll have the final interpretation note uploaded, is they're basically saying that this 12-month period, when you look back, looking at this issue here, and you're looking back over the last 12 months, and if the person's been non-compliant for at least 6 out of those 12 months, then the person is falling short of the eligibility to be a tax practitioner, and Sars can then take steps to deregister that person. Okay, now the issue is, as I mentioned just now, this 12 months is a rolling period. Okay, so if I did this now, 13th of July 2022, I'm looking back to basically from this time in 2021. And let's say that if I look back and I see that this person was non-compliant for more than 6 months of the year because perhaps there were tax returns outstanding, VAT returns, there were payments outstanding. Okay, maybe in 1 month they had a VAT return, in another month they had a payment outstanding, in another month they had they were supposed to have been registered as an employer and they weren't registered, something like that. Okay, so there were different things that were causing the person to be non-compliant at different points over that 12-month period, such that they had kind of non-compliant status for 6 months or more over that 12-month period, which means they were not eligible to be a tax practitioner. Now, let's say Sars then notifies the person that they were non-compliant because of this thing, that thing, that thing, and then the person fixes one thing. All right. Now they might go back on the good old FIFO basis, right? Or go back to the worst, the earliest non-compliance, and they fix that. But now, by the time they do that, we're now 1 month further down the line. We're now in August 2022. So actually, your 12 months that you're rolling back, you're not looking at that earlier month. You're looking back to August 2021. And so this is a kind of a moving situation. And that's what they are illustrating in this interpretation note, is how this works. So even though if you go back and fix your oldest non-compliance, there might be something else that's popped up more recently. And so you might overall still remain non-compliant for at least 6 out of the last 12 months. Okay, so the best thing is just to get yourself compliant as much as you possibly can, and don't ever fall into a situation where you're non-compliant for 6 out of a 12-month period, because then Sars can take steps to deregister you as a tax practitioner. Okay. All right, if there are any other questions on that, you're welcome to raise them. Otherwise, I'm going to start moving into this discussion on the 2022 filing season. We'll see how far we get before we take our leg stretch, and then we'll finish off after the break. I see that there has been a question popping up here. Okay, so I registered originally as I was doing tax returns for third parties for a fee. Okay, correct. I now only do family members and entities for free. How do I ensure I continue to have access to the various tax reference numbers without being a tax practitioner? Look, if you're doing it for free, the best thing is for each person to kind of have their own access onto the e-filing system, and perhaps they can share their access information with you. So it's their password, it's their profile, and you are able to get into their profile and have a look if they give you their passwords and so on. Okay. Because obviously you're not going to be able to have your own access as a tax practitioner as such. All right, but go through their profile and access it through their information. Okay. Yeah, if you have anything else, pop it into the chat box or the Q&A, and I'll pick it up, or maybe I'll pick it up during the break and answer questions at the end of the break. Okay, so 2022 filing season, I'm sure you're all aware that it kicked off on the 1st of July. Now, this notice 2130 has been published in the Government Gazette. This is the annual notice that the Commissioner has to publish to tell us who has to submit tax returns. And I'm going to go through this fairly quickly. There's not too many changes from what we saw last year. Remember that anybody who is required to submit a tax return must be registered. And this brings us to the issue around trusts. So we'll have a look just now at which trusts are required to submit tax returns, pretty much all your resident trusts. And that means that they must be registered as a taxpayer. So anybody who's required to submit a return must be registered as a taxpayer. And that also kicks back to our compliance requirements, right? Remember, I said that the three measurements for compliance is registration, returns, and payments. You must be registered for everything that you're supposed to be registered for, and you must be registered within 21 business days of becoming obligated to register. Okay, and the other thing to remember is that even if you've been registered for 40 years, you still must remember to notify SARS of any change in your registration particulars. That's also an obligation that has to happen within 21 days. And if you've moved, you've changed your bank account, you've changed your email address, anything like that, you need to notify SARS of any change in your registration particulars. Otherwise, you are not compliant as far as your registration requirements are concerned. Okay, in terms of definitions, very quickly, the 2022 year of assessment for a company, any year ending during 2022. So you've got a financial year that has a 2022 at the end of it. That's what we're talking about here in terms of this requirement to submit tax returns. Of course, all other persons, we're talking about the year ended February 22. And the income tax return, I think that's fairly self-explanatory, but notice it does include a turnover tax return if a person is registered as a micro business. Now we go into the requirements of who has to submit tax returns. Okay, so companies, which companies? Not every company has to submit a tax return. It's a company that falls into any one of these categories, and you'll see there's 4 of them. So if gross income is more than R1,000 for the 2022 year of assessment, gross income, right? Not taxable income. Or if they have an asset that costs more than 1,000 or liabilities of more than 1,000 at any time during the year. So notice here, it doesn't just say companies that have traded. It's not a case of whether you've traded or not. You might not actually be trading, but you might have assets and liabilities, right? Then you do have to submit a tax return. Or if you've got a capital gain or capital loss, not a taxable capital gain, or that it's an actual capital gain or capital loss of more than R1,000 from the disposal of an asset to which the 8th schedule applies, or you have any taxable income, any taxable turnover if you're a micro business, any assessed loss. Okay, so even if you're not actually deriving income this year, of course, then it's questionable as to whether you'll be able to continue with your assessed loss. But the fact of the matter is that if you have an assessed loss or an assessed capital loss, if none of these others applies, but you have any of those, you have to submit a tax return. With non-resident companies, of course, non-residents are taxed on SA source income. Now, if you've got a non-resident company, if they're carried on a trade through a permanent establishment in the Republic, or they derived income from a Republic source, or any capital gain or loss to which the 8th schedule applies. And the 8th schedule in respect of non-residents applies to immovable property in South Africa or any asset attributable to a permanent establishment carried on by that person in the Republic. So it links to this part over here. Okay, so those non-resident companies have to submit tax returns. Notice also, Any company that was incorporated, established, or formed in the Republic, but is not a resident for this year because of the application of a DTA. And so when we look at the definition of resident for a company, it talks about, in the first instance, any company incorporated, established, or formed would be a resident, or any company that is effectively managed in South Africa. All right, place of effective management is in South Africa. They become a resident. But then the definition of resident excludes any person who's deemed to be exclusively resident in another country because of the application of a double tax agreement. So you might have a company that was indeed incorporated in South Africa, but then somewhere along the way, the place of effective management has shifted to another country. And that country, the DTA between that country and South Africa might well say that that company is now deemed to be exclusively resident in the other country where it is now effectively managed. It's no longer a resident of South Africa, but notice they are still required to submit a tax return. Okay, so it simply says any company in this category must submit a tax return. Okay. Right, and then trusts. So this big issue about trusts, notice any trust that was a resident during the 2022 year of assessment must submit a tax return. So every trust, doesn't matter whether they earn income or not income, or they've received income and it's all been attributed to other persons, it's been distributed to beneficiaries, etc., the trust still has to submit a tax return. And if it's a non-resident trust, again, similar to what we saw with the non-resident company, if they have a permanent establishment in the Republic, they have income from a Republic source or capital gains or loss to which the 8th schedule applies, then they must submit a tax return. Okay, so let's take a 15-minute break, and then after the break, I'll talk about natural persons. It gets a little bit more complicated there because you've got the exclusion, and then we also get to talk about auto assessments. Okay, so let's take our 15-minute break. So we'll reconvene at 14:35, and I'll see you then. Perhaps if Danny or Stan, I don't know if you've got a little countdown mechanism or if you all just keep track on your phones, and we'll see you back here at 14:35.
That's fine. We'll pay attention to the time. Thanks. Okay, it's 14:35. I don't know, Jackie, are you ready?
Yes, great. Okay, let's get ourselves going again. Right, thanks. Okay. Oh, see a bit of a. Let me just sort this out here. Okay. Right, I just saw a bit of a reflection there. Okay, so I was having a look at some of the questions here on Q&A. I see questions around tax returns for NPOs, Section 21, schools. Well, if you have a look at the regulations, it kind of all sits with the regulation in terms of who has to submit a tax return. So it depends on the legal form of that entity, right? So if it's a company, notice here that when you talk about the obligation on a company to submit a tax return, it doesn't talk about if it's tax exempt or whatever. It talks about the gross income, the amount of assets. Now, of course, tax exempt entities have specific tax returns that they would submit. So yeah, it depends. Is it a company? But this talks about resident companies and juristic persons, and then of course trusts. Okay, then we get on to individuals. Oh, let me just go back to this question from George around tax returns for trusts. Must they be filed by tax practitioners, or can the trustee of the trust? I do recommend you have a look at the Sars website. They've set up a very nice little section on tax returns for trusts, and they do make the point that, yeah, it can be a trustee that submits the tax return. That's absolutely fine. And of course, the trustee doesn't have to be reimbursed for that. It could be part, it depends on the role of the trustee in that particular capacity. Sometimes you have specific professional trustees and so on, right? In which case it could be part of their fee, covers the submission on the tax return. It just depends on the situation. But the short answer is yes, the trustee can submit the tax return. It doesn't have to be a separate registered tax practitioner that does that. Okay, so I think we've done that, and dealt with that. Okay, now resident natural persons. Okay, so individuals, who has to submit a tax return as an individual? Anyone who's carried on a trade other than as an employee, or capital gains or losses exceed 40,000, obviously, because your annual exclusion is 40,000, especially with capital gains. You've got anything over and above that, you're going to have a taxable capital gain. And capital losses, if you've got a capital loss exceeding 40,000, you're going to have an assessed capital loss carried forward for the following year. Okay. Now notice this one, even if you have no income or anything else, if you've got funds in foreign currency or you own assets outside the Republic with a total value exceeding 250,000. I think this is actually from our last year's slide. I don't think that amount's actually changed, but 250,000 at any time during the 2022 year of assessment. And any income or capital gains from funds in foreign currency or assets outside the Republic that were attributed, that's in terms of Section 7, where you know, income accruing to one person is deemed to accrue to the donor, etc., and the equivalent of the paragraph 68 to 72 of the 8th schedule. So if you've got any income that is deemed to accrue to the donor, or capital gains that are attributed to the donor under either of these provisions, then that person has to submit a tax return. And any participation rights in a controlled foreign company, any person who had taxable turnover, that would be where they have a micro business, and any gross income in excess of the tax threshold. Oh, I see, I've still got the previous years. Yeah, that's right. No, the 2022 tax threshold amounts are over there. Okay, so the under 65, under 75, and then over 75. Okay, so any of these people has to submit a tax return unless they are excluded under paragraph 3. And of course, that's the exclusion, which is quite important. On the one hand, it talks about auto assessments. On the other hand, it talks about persons earning only remuneration from a registered employer, etc. Okay, now, if a person, before I get to that exclusion, let me just talk about non-resident individuals. Remember, again, non-residents are taxed in South Africa on SA source income. All right, so if the person carried on trade in the Republic other than as an employee, or they've got any capital gains or losses from an asset subject to the 8th schedule, or they had gross income in excess of the tax threshold, or they had gross income that included interest, SA source interest that was not exempt under 10(1)H. All right, so that's SA source interest. Now, normally non-residents get their 10(1)H exemption, and that's a full exemption on interest, South African source interest accruing to a non-resident, but they lose that exemption if they were in South Africa for more than 183 days in the 12-month period before the interest is actually paid out. Okay, so if they've lost that exemption because they've basically spent, more time in South Africa than they should have in terms of the eligibility for the exemption, then they need to complete a tax return. And it's quite interesting because it's talking about a non-resident earning SA source interest, not exempt under 10(1)H, so they don't get the blanket exemption, that then presumably they would still be looking at the local interest exemption, 23,800 or 34,500. But this is talking about gross income. So even if it is fully exempt under one of those thresholds, technically they're still have to submit a tax return. Okay, so that's as far as your non-resident individuals are concerned. Deceased estates, if they have any gross income, unless they're excluded under paragraph 3, and then any other person who's required to submit a tax return. Now, let's have a look at this paragraph 3 exclusion. So a natural person or estate of a deceased person, and that links back to what we said over here, deceased estates, if they've got gross income, unless they're excluded under paragraph 3, all right, or a natural living person, is not required to submit a tax return if their gross income consisted solely of one or more of the following. Now, this whole story here hasn't changed, but I just want to emphasize that I think a lot of times people misread this, and sometimes, let's face it, the information that comes out from Sars is a little bit conflated, and then it becomes a bit misleading. But what we're saying is that we've got a natural person whose 2022 gross income is consisting solely, only of one of these 4 types of gross income: remuneration from a single source not exceeding 500,000 and employees' taxes being correctly withheld. The other one is SA source interest up to the exemption. In other words, it would all be exempt. Okay. It does say other than from a tax-free investment, but then you see down number D, it talks about a tax-free investment. So interest that would be fully exempt. Dividends, if the person was a non-resident. Now, this is an interesting one because local dividends, and this is talking to local dividends, all right? This is talking to local dividends because foreign dividends is a separately defined term in the Income Tax Act. This is speaking to local dividends. If the natural person was a non-resident, now local dividends for any person are usually exempt under Section 10(1)K. But this is saying that if you're a resident and you derive dividends, that falls outside of this parameter over here, even if it's fully exempt under 10(1)K. This is only saying that you would qualify for the exclusion if your gross income comprised of, let's say, dividends, if the natural person was a non-resident throughout the 2022 year of assessment. So if you're a resident who's getting dividends that are fully exempt under 10(1)K, this is indicating that you still would need to submit a tax return, okay? Bearing in mind that if we go back to this requirement over here, who has to submit a tax return? Any person who carried on trade, had capital gains or loss, had any income, taxable turnover, or gross income in excess of the tax threshold. So if your gross income consisted only of dividends, and I'm really pushing this to the nth degree here, and it was less than the tax threshold, then it would not be taxable anyway, in spite of the fact that, dividends would be exempt. But it's just an interesting point here that this paragraph C only speaks to non-residents over here. Okay, but the typical people who make use of this paragraph 3 exclusion are people who are working for one employer during the year. They've got remuneration not exceeding 500,000, and it's been subject to employees' tax correctly calculated, and perhaps they've got a little bit of interest, but it's all exempt under the local interest exemption. Okay, then they don't have to submit a tax return. But notice here that even if you've got an employee earning remuneration from one source, less than 500,000, but if they get any kind of allowance, obviously, or if they get any kind of fringe benefit, or any amount in respect of services rendered outside the Republic, they still have to submit a tax return. That exclusion does not apply to them. They're required to submit a tax return. All right, so it does get a little complicated, and that's why I think it's important to just read this exclusion quite carefully, because if you just read what's reported in the press, you're going to get a very telegram version of this, and it's not going to give you the true picture. So we say in the exclusion applies to these people, but if they're earning an allowance or fringe benefits, or they've worked outside the Republic as a resident, they've worked outside the Republic, and so they're looking at the 101H, the 10102 exemption there, or perhaps the 10101 exemption. But the point is that whether they're looking at the exemption or not, it says if they've got any amount accrued in respect of services rendered outside the Republic, they have to submit a tax return. So even if they're earning less than 500,000 a year from one employer, if they worked outside the Republic, they have to submit a tax return. Okay, so interesting point. I think a lot of people overlook that. Okay, Johanna, I have no idea what you're referring to, in what context. So perhaps if you could just make your question a bit clearer, then I'll be very happy to answer it. Oh, you're talking about this paragraph 3. It's the paragraph 3 of all that I'm talking about here is this regulation. If I go back over here, if you pull up the regulation over here, then you'll see that it has different paragraphs in this regulation. Paragraph 3 of the regulation is the paragraph that talks about this exclusion. Okay, right, and then let's talk about auto assessments covered in paragraph 3.3 of the regulation. Now, obviously, if a person is issued with an auto assessment, they don't necessarily have to submit an income tax return. And so what the regulation says, and this is the law that prescribes who has to submit a tax return, okay? A natural person is not required to submit an income tax return if they are notified by the commissioner in writing, which could be by way of an SMS, that they are eligible for auto assessment, and whatever is shown on that auto assessment is complete. All right, so if you're happy, if you're notified by Sars that you have been auto assessed and you're happy with the auto assessment, then that can be the end of the matter. In fact, as it is for this year, you don't even have to specifically accept Sars auto assessment. If you just have a look at it and you say, okay, everything's fine, and you just leave it, that would indicate that it is all correct and you accept the auto assessment, in which case you don't have to then submit an income tax return. But if you're not happy with what's reflected on the auto assessment, and it's not necessarily that you are sad about it, it's just that maybe you would prefer to go with the auto assessment, but you know that there's other information that you need to provide to Sars that's not reflected yet on the Sars records. For example, if you're a director of a company and you're required to submit a statement of assets and liabilities, and you know that if you submitted a tax return, you would have to submit a statement of assets and liabilities. Sars doesn't have that in their system yet. And so what they're presenting to you with the auto assessment is not actually the full picture. So you would be obligated there to go back and say, no, I need to submit a tax return and provide that statement of assets and liabilities. Or perhaps you sold an asset and you got capital gains. Sars doesn't yet know about it. So they've assessed you based on all the information that they've got from third parties, salary, interest, dividends, but not necessarily capital gain, because maybe the capital gain relates to a property that you sold and it's not coming through on any of the IT3 information that's coming through from the financial services provider. So you are required, you're still responsible as a taxpayer, you still have the responsibility of confirming that you have provided a full and complete return to Sars. So Sars is kind of offering to you and saying, this is what we have, is this okay? If you just accept it, which, as I say, you don't have to specifically say, yes, I accept, you just leave it and say, okay, that's it, silence is acceptance in that case, then, that's the end of the story. But if you know that there's additional information that has to be provided, you would have to then say, I don't accept the auto assessment, and then you would have to go in and submit a return. Now, let me just pause there and just check any questions. Okay, I'm not sure. Auto assessments are being paid out. Is this where there's a refund? And I think that you need to go in and look at the auto assessment that has been issued. And if possible, and I hope it's possible, and this is part of the teething problems with the e-filing system, hopefully it's possible that you can indicate there that you're not happy and you want to submit a tax return. Okay. Right, Sam, I knew somebody was going to ask about this because this is about my next point about auto assessments. Now, if you look at the Sars website and you look at the information, and this has also been given in the recent communication that's come through from the Rcbs. But SARS has indicated that if you receive an auto assessment and you indicate that actually you're not going to accept the auto assessment, you need to submit a tax return. If you have a look on the SARS website, you'll see that they tell you there that you then have 40 days in which to submit that tax return. And I can imagine that this is probably going to cause quite a lot of confusion, because if you think about it, the deadline for submission of tax returns, and let me just go to the next slide, and I think I've got the dates on the next slide there. Yeah, here's the filing deadlines. For persons other than companies, I think you all know that a company is 12 months after the financial year. But for others, it's 24th of October if you're not a provisional taxpayer, or the 23rd of January next year if you are a provisional taxpayer. Okay, now, of course, the one thing is to make sure that you know whether you're a provisional taxpayer or not. And I think a lot of people realize how important that question is when we dealt with the previous filing season. But even if you are not a provisional taxpayer, and generally speaking, if you're a provisional taxpayer, I would suggest you should not be auto-assessed. Well, perhaps if you've got a lot of investment income, and so everything is driven through the financial services sector and everything's driven through IT3s and so on, then perhaps auto-assessment would work. But for many provisional taxpayers, it's because they've got their own business going on, or they're getting rental income, which doesn't necessarily flow through a third-party data situation. Okay, so then auto-assessment is not suitable for those people. And so you would immediately go back and say, okay, no, I shouldn't be auto-assessed. I need to submit a tax return. If that happens today, then in terms of the rules, you would have to then submit that tax return in 40 business days, which is taking you through to kind of towards the end of August. Okay. Whereas these dates are saying that you've actually got until January 2023, or if you're not a provisional taxpayer, you've got until the 24th of October. So you might say, well, how does this all work now? Where does this 40 business days come from? Well, the thing is that, of course, everything that SARS does has to be done in accordance with the legislation, right? They can't just make up their own rules and suddenly construct this thing. Well, they kind of did, and then they amended the legislation to fit in line with it. But anyway, it has to fit in line with the legislation. And this auto-assessment actually falls into Section 95 of the Tax Administration Act, which is the provision that deals with estimated assessments. And it's a provision that says that if a taxpayer doesn't submit a return to SARS, SARS can raise an estimated assessment. Okay, but this has been done not in a negative penalizing sense. It's been done in the sense of supposedly helping taxpayers by SARS coming forward with information and saying, this is what we have, we will raise an assessment based on this. But that assessment that they're raising is now going to be, that auto assessment is an estimated assessment. So even if it shows a refund and you go back in and say, hold on, no, I need to submit a tax return, I don't accept the auto assessment. In terms of Section 95, dealing with estimated assessment, it says that if the taxpayer then wants to submit their own tax return, under Section 95, it says that the taxpayer may, within 40 business days from the date of the assessment, request SARS to make an amended assessment, basically. So that's where that 40 business days comes from. It's something within Section 95 of the Tax Administration Act. And I can imagine this is going to cause quite a lot of confusion for people, because you would tend to think that if you're a provisional taxpayer and you get this auto assessment and then you say, no, I don't want it, I need to submit a tax return, you would immediately think that you've got until the end of January 2023 to submit that tax return. But actually you're into a different system now because you've been auto assessed and you never chose to be auto assessed. SARS has simply auto assessed you. I don't know if any of you are in this situation that you might have received an auto assessment. I think you need to check this quite carefully on your systems with your clients, because I'm not even sure as a tax practitioner, will you know if your client is being auto assessed, if the SMS is sent directly to your client? I think you just need to check that and also warn your clients, that they need to notify you and send you the information immediately if they have been auto assessed. because you've got basically, you've got now 40 days to submit an amended return. But it's not all bad news. It's not necessarily just a 40-day period, because what happens is that if you can't submit within 40 days, and let's face it, people are not geared up for this. This is basically saying that you're going to submit by late August. If you can't do that, then what they say is that you can apply, guess what, for an extension. We're back to that again, that you apply for an extension. And that's also catered for in Section 95 of the Tax Administration Act, which says here, so it initially says that if you've been auto-assessed, you've got your estimated assessment, which is, so auto-assessment is a form of an estimated assessment. If you want to submit your own return, excuse me, you've got within 40 days to do that. But then it goes on in the next subparagraph, Section 95(7), to say, if reasonable grounds for an extension are submitted by the taxpayer, a senior SARS official may extend that 40-day period for another 40 days. All right, so that would then take you from August to kind of like probably close to the 24th of October. But you'd have to apply for that additional extension. So you've got 40 days. So you don't accept the assessment, you've got 40 days to submit your return, or you've got to apply for an extension for another 40 days. And if you feel that even that additional 40 days, which takes you to the end of October, if that's not enough, well, you can go further. Because actually it says here that further extension can be 40 business days or the 3-year period, which is referred to in Section 99(1), whichever is the longest. So it can actually go up to 3 years. But in terms of the filing deadlines, of course, it could only go up to then, if you're a provisional taxpayer, 23 January 2023. So I think the key thing is, if you're finding all of this just a bit overwhelming, and it all sounds just pretty scary and complicated, what you need to do is to go onto the SARS website and go into types of tax, personal income tax, tax season. Okay, so I gave you the link earlier to the tax season, or it's coming up in the next slide, perhaps. Yeah, there we go. The tax season website, right? Personal income tax, tax season. And then you'll see there that they've got a category saying, how does auto assessment work? And just read through it. They've even got a little video, but I didn't find that terribly informative. I did watch it, but I didn't find it terribly informative. But they do have some frequently asked questions there around auto assessment. How does it differ from last year? How does it work? What do I do? And this whole issue around requesting extension. So as far as I can see, when you get an auto assessment, it's got a couple of fields on that auto assessment, and one of them is the field where you request an extension. And I think, anybody who's got an auto assessment, you should immediately request that extension, because that's going to give you the additional 40 business days. And then, of course, if you want to motivate to go beyond that, and I would suggest that surely the Rcbs must take this up with SARS and say, hold on, if this is a provisional taxpayer who's been auto-assessed, they never asked for it, there should be an automatic extension through to the end of January. But right now, we don't have that. You've actually got to apply for that extension. Okay, so I think it just sounds to me like it's just making it complicated. Okay, you'll only know if their tax profiles are linked with yours. And I think, Sam, this is my concern. I think my big warning to you as tax practitioners is warn your clients and ask them to tell you as soon as they are notified that they've been auto-assessed, so that you can then go into their profile and pick up the auto-assessment. Okay, unless you are able to go in and check every single one of your clients. I understand that SARS should have issued the initial batch of auto-assessments was supposed to have been issued by even Monday or Tuesday this week. But I don't know if that's actually happened, of course, because now with the strike action and so on, things might be taking a bit longer than they initially planned. So, I think it's going to be something that you're going to have to manage quite carefully. Don't leave it, because, some of these provisional taxpayers, you only get around to looking at doing their tax returns in January next year, only to find that they were auto-assessed, 7 months ago. And then that can only lead to complications. So you need to find out pretty soon if people have been auto-assessed. and then deal with it accordingly. If a person, obviously, if they've done nothing, because there's no facility to accept an auto assessment, there's only a facility to say, no, I don't accept it, I need to submit a tax return. So if the person's received the notification and they've done nothing, you still have the opportunity then, of course, to go back to SARS and say, no, we don't accept it. But you need to do that ideally within the next 40 business days, so that you're within this time frame of 40 business days. Although Section 95 does say that you can still request an extension after the 40 business days has passed. But I think, yeah, you just don't want to make this unnecessarily complicated. Okay, yeah, I don't want to go on and on about stuff that maybe I'm saying too much about, but my key guidance is to go and have a look at the SARS website over here, this personal income tax season, and then have a look at what they say there about auto assessments. And please read it. Anybody who's attending to clients during the filing season absolutely needs to read this to make sure that they know exactly what's going on here. Okay. All right, then I'm going to move on to the next section. I'm going to go through this pretty quickly. And this is just amendments which have taken effect in 22-23, just to highlight, and a lot of this you'll be aware of. The one is the method of calculating PAYE on pension annuities. This changed from the 1st of March. So remember that a pension annuity, and this could be an annuity paid by a pension fund, and as you can see here, pension preservation, provident preservation, or retirement annuity fund, or an insurance company if there's a purchased annuity, right? So any of these annuities, an annuity is a form of remuneration, and so the fund paying that annuity becomes the employer in that context and has to withhold employees' tax, and as we discussed earlier, has to withhold the correct amount of employees' tax. And it used to be that the employees' tax used to be worked out according to the tax tables in the normal way, as you would do for any employer. But from the 1st of March, that is changed. From the 1st of March, SARS will notify the funds of what rate, and it's a fixed tax rate that has to be used to withhold the tax. Well, to say it has to be used is a bit misleading, because SARS will notify the fund of what the fixed tax rate is, and the fund, and as far as I've seen, the funds have notified their members, stroke clients, stroke pensioners, that, you know, this is what's coming into effect, and they give the person the option of saying, do they want to rather have the tax calculated in a different way? So the default is this fixed tax rate that SARS is using, but as SARS has indicated, the pensioners can either accept that rate, or if they're not happy, they can have a look at this over here, request their retirement fund administrator, that's RFA, all these acronyms, right? RFA, retirement fund administrator, to continue to deduct PAYE at a higher rate or a rate according to the normal tables. Okay, so they can request that. But the idea here is to get a little bit more tax withheld every month from these annuities to avoid people having to pay in additional tax on assessment. So, but it can, in some cases, result in a situation where the person is actually paying more tax than they really need to. From what I've seen, some people who've suddenly found, whoa, I'm getting like 2,000 Rand less per month through my annuity. And then when you talk to that person, it seems like they're just paying way too much tax right now. And they're going to end up in a refund situation, which is not advisable. Rather, do a quick estimate of how much tax that person is going to have to pay for the year, taking into account all of their income, bearing in mind, you know, an annuity might just be one slice of the cake, but there might be other income that comes into the equation as well. So do a calculation, see how much tax they're going to have to pay, divide that by 12, and that's how much you want to be paying on a month-by-month basis to make sure that you don't end up having to pay in additional tax at the end of the year, but you also don't want to be in a tax refund situation at the end of the year. Okay, so that's as far as those annuities are concerned. And then your long service awards. So this is one of the few little kind of tax-free concessions we have in the tax legislation, is this long service award. And it used to be only if it was an asset that was given to the employee, but now from the 1st of March, they've expanded that. It can be an asset, or it can even be cash. It can be the right of use of an asset or free or cheap services. So there's various ways of giving a long service award. And the idea is that if you do a combination of these different things, cash plus an asset plus maybe a free spa treatment, free services, whatever, the total value of all of that, the first 5,000 Rand is tax-free. So the amount hasn't changed. It's just that it used to be only acquisition of an asset, but now it can be these other things as well, or a combination of these different things. Okay, remember that long service is defined in paragraph 5, and it talks about an initial unbroken period of 15 years and thereafter every 10 years. So we really are talking about long service here. Okay, but it does mean that you have a little bit more latitude in terms of what you can do for your employees with a long service award. And then in terms of annuities, I think you're all aware that when we look at the approved funds, pension and provident funds, and even retirement annuity funds, we have certain definitions in section 1 of these funds, and that kind of governs what the rules of these funds have to state. And one of these key things is that not more than 1/3 of a retirement benefit can be commuted for a single payment. In other words, you cannot take more than 1/3 of your total retirement benefit as a lump sum. Now, of course, with provident funds, they changed a couple of years ago, and we had a protection of vested interests and so on. I'm not going to go through to all of that. But we have this compulsory annuitization situation. And it used to be that we were fairly limited in terms of how these annuities could be paid out. But now they have expanded that somewhat, in that the annuity that is paid can be any form of annuity, including a living annuity. It can be a combination of different annuities. So you can, for example, have, let's say that you've got 300,000 Rand available to take an annuity. So you can use all of that to take an annuity from your pension fund, or the pension fund can go and buy an annuity from the insurance company, pay it out to you, or you can go and buy yourself a living annuity with that amount, all right? But the key thing is that if you split it and you're going to take, let's say you've got 300,000, you actually probably can't split that, because you can't buy any annuity if 2/3 of the total value used to buy that annuity does not exceed 165,000. So if 2/3, 165,000, 3/3, or the full amount, we're talking 247,500, okay? So you've got to have a minimum amount of 165,000, 2/3 of that amount, to buy an annuity. So if I had 300,000, the reason why I'm saying you can't really split that is because if you split it 50-50, you've got two amounts of 150,000, you would not be allowed to use that to buy an annuity. Okay, and if you took 165, the change is 135, which is then not, it's too small. So you'd have to then keep your 300,000 together, and you'd have to get one annuity with that amount. Okay. So this is the rule that's come in from the 1st of March this year, is that you have more leniency in terms of the spread of different types of annuities that you can take, but you've got a de minimis of this 165,000 for any particular annuity that you want to invest into. All right, or if the employee or the member is deceased, or they want to transfer their interest to a preservation fund or a retirement annuity fund. Okay, and that's that point there, that the amount to buy any one annuity must exceed 165,000. There's further information in BGR 58. That was actually published back in November 2021. Okay, and then also, of course, we know that the corporate tax rate is reducing down to 27% for years ending 31 March 2023 and later. And together with that, we're going to have this amendment to section 20 that's becoming effective. So it's effective 4 years of assessment ending 31 March 2023 and onwards. And it's going to limit the set-off of your assessed loss. Now, it's very important to bear in mind that this limitation of assessed loss only applies to companies, right? They've split section 21A into two parts. And the part that relates to persons other than companies, it's exactly what it said before. But the limitation applies to companies. And what it's saying is that your set-off is limited to the higher of R1 million or 80% of the current year's taxable income. And so for smaller companies where their carry forward assessed loss is maybe only 800,000, well, then you would be able to set off the whole 800,000, okay? Because 80% of the current year's taxable income, or R1,000,000, the higher of those two figures, and so you'd be able to set off the whole amount of 800,000. Okay, so it's just to make sure that companies that have had huge amounts of assessed losses carried forward from year to year, they might end up then with an aspect of 20% of their current taxable income on which they have to pay tax. So if we look at this example over here, if we have a company with taxable income of 2 million for a June 2023 year end, and they've got an assessed loss brought forward from the previous year of 2.5. So under the old legislation, you would have said, right, my taxable income is 2, I can set off my assessed loss of 2.5, and so I have no taxable income for June 23, and I've got a remaining assessed loss of R500,000, which I carry forward to the 24 year of assessment. But with this new amendment, what you have to do is you say, right, there's my taxable income for the year. What can I set off in terms of my carry forward assessed loss? So I look at my assessed loss of 2.5 million. Okay, I can set off up to the greater of 1 million, or 80% of my current year's taxable income. 2 million times 80% is 1.6 million. So the higher of 1.6 million or 1 million is obviously 1.6 million. So in that case, I can set off 1.6 million against my current year's taxable income, leaving me with remaining taxable income to be taxed of 400,000. And that, because you've got a year of assessment, June 2023, it's ending on or after 31 March 23, we've got the 27% tax rate. Okay. And then our assessed loss was 2.5. We can use 1.6. We've got 900,000 that we carry forward. So don't lose that. And there's no timing restriction there. You can just keep carrying that forward. Okay, but it does mean that you have an exposure of some of your taxable income that becomes payable for this year. Now, I think we also just need to think about this in terms of our provisional tax calculations, because if you think about it, this amendment is affecting companies for the first time 31 March 2023. So we come back to the first provisional payment, which would be September 2023. In this particular example, I've got a June year end. So the first provisional payment would be December. All right. But now what do I do with my first provisional payment? Well, of course, you have to say, what is my estimated taxable income? And what is the rule for the first provisional is that you can't go below the basic amount. So the basic amount is my last assessed taxable income, which was from the previous year. Okay. And that was an assessed loss of 2.5 million rand. So in effect, my estimated taxable income is nil, and there'd be no provisional for the first return. In the second return, now you've got to get your second provisional return has to be within 80% of your final assessed taxable income for that year. Now, remember that your final assessed taxable income is going to be after setting off your assessed loss, because your taxable income is after applying Section 20, right? So your final assessed taxable income for this year is 400,000 Rand. So your second estimate can't be less than 80% of that amount, which would be 320. And so you would then have to pay your second provisional 27% tax on 320,000 would be 86,400. So you must pay that by the last day of the year of assessment. Okay. And of course, if you did get this estimate too low, if you went in with nil, still looking back at if you forgot about this limitation of the set off, and you look back and you said, oh, well, I had an assessed loss last year, so I'm going to go in with an estimate of nil, then you're going to end up with an underestimate, and you could end up with an underestimate penalty. Okay, so you want to make sure that you are very careful about the limitation of the assessed loss when you deal with your provisional returns, especially your second provisional return. Okay, all right, so those are the main things I wanted to mention about this year's judgments. I'm not seeing any other questions coming through, so I'm going to just steam on ahead onto the tax judgments. So I've got 4 that I'm going to talk about. The one is another constitutional court case, which is really interesting because we don't have many tax cases that have gone through to the Constitutional Court. I can think of the one VAT case dealing with the Red Cross Society. It was under a different name, but that went through to the Constitutional Court around their tax exempt and a zero rating of VAT. And then, of course, we had the Big G case and the Clicks Club card case, both dealing with Section 24C. They both went through to the Constitutional Court, both unsuccessful. And now we have this case going through to the Constitutional Court. And what is really interesting is that it involves what is explained to us as being a fairly small taxpayer, but obviously a very important principle in question here. And so it must have been that there was some sort of, somebody did this in the interests of tax legislation going forward, because it would seem that this taxpayer would not have specifically had the financial means to go to the Constitutional Court. But it's really nice that they did, because it's given us some clarity on a very important issue. And then I'll come to these other cases, but let's go and have a look at Barnard Labuschagne. So this Barnard Labuschagne was a small legal firm, all right? And what had happened is that they had actually had a case that went to the Western Cape Division of the High Court back in 2020, and they lost the case there. The taxpayer was contending that a tax judgment was capable of being rescinded, because they said the tax judgment was based on inaccurate information and should be rescinded. And the High Court held that that tax judgment could not be rescinded. Now, BLI contended that if it wasn't capable of rescission, then they also wanted to contest that these provisions, which dealt with the tax judgment, Section 172 and 174 of the Tax Administration Act, they wanted to argue that those were constitutionally invalid. But the application the appeal was turned down by the High Court, and the application to appeal was dismissed. They applied for leave to appeal to the Supreme Court of Appeal. That was also dismissed. And so they actually had no other option than to go directly from the High Court to the Constitutional Court. So they applied for leave to appeal to the Constitutional Court, and that was approved. So Rogers AJ confirmed the jurisdiction. Of course, we can't all just take our tax matters to the Constitutional Court, even if we had big pockets, because it's going to cost you an awful lot of money to go to the Constitutional Court. But even so, it doesn't matter how much money you have, the Constitutional Court has certain parameters, and they're not going to just accept any kind of tax case that comes before them. In this particular case, and it's also links to the tax cases that came previously, and I think especially the Big G case and the Clicks Club card case, all right? In those cases, both of them, they had an arguable point of law of general public importance. And in this case, he said that this application on the question of whether a tax judgment was capable of being rescinded, it's a question of rescindability, it raises an arguable point of law of general public importance. And therefore, they said, we will consider this case. They also, when they looked at the High Court judgment that considered this particular matter, they were extremely critical, because they also said that the High Court judgment had not taken into account some binding legal precedent that should have been considered. And so they said there that the judgment appeared to have failed to apply binding precedent, which is a core component of the rule of law and a founding value of our Constitution. And it's basically an error. It's a failing. And they said, we have to redress this, and therefore we have jurisdiction. So on that basis, they were willing to consider the case. Now, the background being a small law practice, been around for some 20 years. Notice here, a small law practice. Okay, I don't think huge pockets to pay for the legal counsel that you need to go to the Constitutional Court. But the particular matter was that they had encountered, some of you might remember we discussed this High Court case a couple of years back when the judgment was handed down. But this particular law firm had difficulties with Sars as far as their account was concerned, their statement of account, and it related to some self-assessments for VAT, PAYE, UIF, and SDL, so employees tax and VAT. And there were certain payments made, which seems that Sars had misallocated the payments. And as a result, perhaps payment made for employees tax was allocated to VAT, and then the employees tax was said to be outstanding, and therefore late payment penalties started to be levied, interest and vice versa. It seemed to just be a mess that went on for some 8 years. And eventually Sars came up with a statement reflecting a certain amount of tax that they said was payable. The taxpayer wasn't happy with that because they said that that statement was incorrect. It was based on incorrect information because these payments had been incorrectly allocated. Okay. And nonetheless, Sars issued a letter of final demand, and they then went ahead and appointed the bank, Absa Bank, as an agent, all right, to then take the money out of the client's bank account, basically. And they notified the bank that they had been appointed as an agent. They received a negative response, which I guess must have meant that there was no money in the bank account. And SARS then issued a letter to the applicant. So the next step in the collection process, saying, right, we're going to now go take a civil judgment against you to collect this outstanding debt. Okay, so they issued a notice to the client to say they're now going to approach the High Court to get a civil judgment to secure that debt and obtain repayment of the debt. Well, they didn't get any response, so they went ahead and obtained the judgment. They went to court, got the judgment, and they filed, in order to do that, they filed the statement in terms of Section 172, in which they said that there's an amount of tax owing of some 800,000 Rand. The taxpayer then asserted that their statement was wrong because SARS had misallocated some of these payments and so on, okay? But now the judgment has been handed down. Now, it was handed down in terms of Section 172, which is part of the SARS collection process. And this provision in the Tax Administration Act says that when there's an outstanding tax debt, SARS may, after giving the person at least 10 business days notice. So here it was said that SARS did give them notice, but they didn't hear from the taxpayer. So they went ahead, okay, and lodged this statement with the court, and that would then give rise to this statement, which has the effect of a civil judgment. Okay, so that in terms of Section 174, the statement filed is treated as a civil judgment once the court approves it. Now, a civil judgment is one thing. This has the effect, it's treated as a civil judgment. And that seemed to make a difference in terms of the High Court case, because when the taxpayer then said, hold on a minute, we must rescind that judgment, it's based on incorrect information, and the High Court held that you can't rescind it because it's not actually a civil judgment, it's a tax judgment, which has the effect of a civil judgment, but it doesn't have exactly the same legal status, and so it's a tax judgment in inverted commas. Right? It's not capable of rescission. This is what the High Court said back in 2020. And they said actually that the taxpayer is using the wrong process here. They should have used the dispute resolution process. The taxpayer said there's no actual assessment here. We're fighting about a statement of account. And so we can't go the dispute resolution process because there's no assessment as such. And so, yeah, so that's the point at which the High Court basically turned down the taxpayer's appeal. And that's when the taxpayer then went through and took the appeal through to the Constitutional Court. So the Constitutional Court, remember, was extremely critical of the High Court, saying that they had overlooked some extremely important previous judgments, which did give the effect of binding precedent. Now, remember, it was the High Court considering that appeal. So that what is binding on the High Court is, of course, more senior court judgments, which would be an SCA judgment or a Constitutional Court judgment, would be binding on the High Court. But even other high courts should still have some kind of influence or impact, right? Even though it's not necessarily binding. Now, if we look at these other judgments that the Con Court said should have been considered, we got Kruger versus CIR, a 1966 case, a High Court case. So that wouldn't be binding on another High Court, but it would be persuasive. Okay, and in that case, it was held that a tax judgment was susceptible, it was capable of being rescinded. But then that same Kruger took that matter on appeal up to what was then the appellate division, right, SCA now. So here we do have a higher court, and that appellate division emphasized its view that tax judgments, although it wasn't the central matter of the case, but they did emphasize that tax judgments were capable of rescission, and they cited examples, including when tax had been incorrectly computed, which is exactly what Barnard Labuschagne was arguing, and they were saying their tax had been incorrectly computed. Okay, so basically what we're saying is there was a binding judicial precedent which had not been taken into account by the High Court, should have been taken into account. There's also, of course, the famous Met Cash trading case, the one that gave us the pay now, argue later principle. But that also confirmed, in line with the Kruger decisions, that a tax judgment is capable of rescission. Yeah, so just really interesting here, because it's also interesting that the High Court overlooked these cases and didn't take these cases into account when the High Court reached this decision back in 2020. And it's also interesting to see that there is another process. Of course, many of us wouldn't be able to follow this process unless you've got friends in high places who can help you to take your case through to the Constitutional Court. But in this particular case, thank goodness, this taxpayer was able to secure the assistance of, no doubt, other people in the legal fraternity who helped them to take this matter to the Constitutional Court. They then said, you need to look at these additional decisions. And they basically referred the matter back to the High Court and said, you need to reconsider this and take these judicial precedent matters into account. So just a really interesting one. And what's also awesome is that here we see a taxpayer who went through to the Constitutional Court and was successful, that they actually won their case. The appeal was upheld. Okay. All right. So I think that's an important one, being a Constitutional Court case. I was talking to an advocate the other day who doesn't deal with tax cases, and I was just saying, it's so interesting to see now. This is our fourth tax case that's gone through to the Constitutional Court, and he was quite flabbergasted. He wasn't aware of it, and kind of said, well, when you think of the amount of money that's involved, it's to be highly unlikely to have tax cases going to the Constitutional Court. Yes, indeed, but this one did go through, and the taxpayer was successful. Right, then we have another case. This is an SCA case, judgment handed down in April, also dealing with tax administration. Just about all of these cases that we see coming through now deal with tax administration in one form or another. It just shows how important it is for us to get a solid understanding of the Tax Administration Act. In this particular case, Sasol Chevron wanted the court to attend to a review application under PAJA, the Promotion of Administrative Justice Act. And basically what had happened here is that Sars, the commissioner, had handed down a decision saying that Sasol Chevron is not entitled to a refund of VAT. And I'm not going to go into the whole discussion around the VAT thing, but the thing is, the tax administrative matter was that they wanted a review of Sars' decision, and they wanted this review to happen in terms of the Promotion of Administrative Justice Act. And of course, many of us talk about PAJA and we say, well, this is awesome, PAJA's there, we can make use of PAJA. If we're not happy with the administrative work that Sars is doing, we can bring a request for review, just like they did under PAJA. But the issue here was whether this review application was valid. And the question was, what is the time frame that has passed? All right, because there's a deadline under PAJA. This is not an open-ended thing. So if we look at the time frame here, Sars notified the denial of VAT on the 6th of December 2017. There was then a further exchange of correspondence, and Sars issued a letter on the 26th of March 18, so sort of 3 months later, but they confirmed their previous stance. And it states that this letter merely restated their original position. So actually the decision had been taken on the 6th of December. Sars instituted a review application on the 21st of September, asking for a review of the, sorry, did I say Sars? It should be, I'm getting a bit tongue-tied after talking for so long. Sasol Chevron instituted the review application on the 21st of September. Now, if you were looking at 180 days, and this is the issue here, let me just scroll forward a little bit. Section 7.1 of PAJA talks about proceedings for judicial review must be instituted not later than 180 days after the date on which any proceedings were instituted, or where no remedies exist, on which the person concerned was informed of the administrative action, became aware of the action and the reasons for it. Now, 180 days. Now, obviously, Sasol Chevron was counting their 180 days from this second correspondence, although they came in, very close, all right? But 180 days from the 26th of March, they thought they were still within that period. But actually, the court was saying, when do we start counting? When does the clock start ticking? And the court said that you basically have to go back to when SARS issued their initial notice in December, because the later notice was merely confirming what they had originally said. So actually the notice had been given in December. And so if you count 180 days, now there is provision that you can apply for an extension, but it was a common cause that neither party had considered any application for extension. And so basically you're saying, right, it's 180 days from the date on which the notice of the administrative action was given. And that would have been December plus 180 days. So actually Sasol Chevron was out of time. All right, so going back, of course, this is the commissioner versus Sasol Chevron. So the appellant is the commissioner and the appeal was upheld with costs. Okay, so the taxpayer lost that one because they had gone beyond the deadline and they hadn't applied for an extension. Then Lavinia is the one about the change in the year end. But as I say, this goes back to 2009. And since then, the Companies Act has changed and the SARS process for dealing with year ends has changed. I'm not really going to talk about this one because I don't want to confuse the issue. I've already explained how to go about changing a company year end and that the information is available on the SARS website. So let's have a look at this next one, which is a really important one. I know it goes back to December, which is actually last year, but I checked and we didn't discuss this in the year-end update because actually the year-end update, I think, happened at the end of November. And so this is a recent judgment that was handed down as a Supreme Court of Appeal judgment. I think many of you have probably heard some of the discussion around this judgment, but it was a judgment around whether this taxpayer was eligible to make use of the voluntary disclosure program. So it's really important because the voluntary disclosure program is a hugely important mechanism for taxpayers to make use of in appropriate circumstances, right? And that's the key thing, is that you have to look at the Tax Administration Act and you have to establish whether you are actually eligible for the voluntary disclosure program. Now, remember that the voluntary disclosure program sits in Chapter 16 of the Tax Administration Act, and it follows directly after the provisions that deal with the understatement penalty. That's the understatement penalty, very specifically, not your administrative non-compliance penalties. The understatement penalty applies when there is an understatement, all right, where you've actually failed to disclose certain information, or you've claimed a deduction that you weren't entitled to, or you failed to submit a return, all right, that has given rise to prejudice to SARS. Then you've got an understatement, okay? And the voluntary disclosure program links to that understatement penalty. Indeed, if you look at that understatement penalty table, you will know that in some cases, you can actually get that understatement penalty down to 0% if you apply for the voluntary disclosure program before SARS is aware of the default. Okay, now, in this particular case, the taxpayer had imported aircraft into South Africa and they were liable for VAT, but they hadn't paid the VAT on the importation. And so this whole thing revolves around this VAT that wasn't declared to SARS. The taxpayer they started getting a bit worried, should they have paid VAT? And they used SARS as their tax advisor, and they kind of phoned up SARS and asked SARS about the matter. And SARS said, yeah, for sure, you should have paid VAT, and there's going to be penalties because you didn't pay VAT. Now, at the point where they approached SARS and asked for SARS advice, SARS now knows about this, okay? They're not necessarily have done an audit, but they know about it. Somebody at SARS now knows about this non-compliance. All right, so just bear that in mind. The applicant later, and later is an understatement because it was like a year later that this applicant then applied to SARS for the VDP. Now, when you look at the VDP, and it talks about eligibility for a VDP, okay? And the eligibility is stated in section 227, requirements for a valid disclosure. In order to have a valid VDP process, in order to be eligible for the VDP, your disclosure, and the first thing is there must be a disclosure. Now, I've just said that SARS already knew about this. And so this is part of the problem here. If they already know about it, is there actually a disclosure? Okay, but to be a VDP, you must have disclosure. And that disclosure must be voluntary. It must involve a default. And when we look at that definition of default, default is defined in the Tax Administration Act in Section 225, and default means that there must have been a submission of inaccurate or incomplete information to SARS, or a failure to submit information, or the adoption of a tax position where the submission, non-submission, or adoption resulted in an understatement. Remember, I said it links to that understatement concept. So there must be a default which would link to an understatement, which would trigger the understatement penalty if SARS knew about it. Okay, so that's the second requirement there. And your application must be full and complete in all material respects. It must involve a behavior referred to in column 2 of the understatement penalty table in section 223, and that speaks to behavior being either reasonable care not taken, no reasonable grounds for a tax position, there's impermissible avoidance arrangement, gross negligence, or intentional tax evasion. That's the behavior. It must not result in a refund by SARS, and your application must be made in the prescribed form and manner. Okay, so before you rush in and go for the voluntary disclosure program, you've got to check that you tick all of these boxes, starting with the first line. Is there a disclosure? And then does it meet all 6 of these requirements over here? All right, now in this case, the taxpayer purveyor, remember they had already told SARS about this thing, okay? So when they applied for the VDP, their VDP was actually rejected, the application, on the basis that it did not meet these requirements of section 227. And in the judgment, and it's quite interesting to go and read this judgment, I must say, talking about how they consider the requirements for a valid VDP application. And the key things that they focus on in the judgment is this question of, is there a disclosure, and is the disclosure a voluntary? Alrighty, so that's really what they're looking at there. And they said, well, is it voluntary? They said the VDP application was prompted by compliance action. In other words, the SARS officials told you, if you don't sort this out, you're going to pay a penalty. Well, the fact that you didn't pay the VAT, because obviously there's a time frame here, if you didn't pay the VAT on importation, there's going to be a penalty. And in light of that advice, in order to escape payment of penalties and interest, purveyors applied for the VDP. So they're saying that actually it wasn't voluntary, that purveyors was actually coerced, if you like, almost forced into applying because of the fear of penalties and interest. And so that this judgment, what it's telling us is that if people apply for a VDP out of fear of penalties and interest, then there's a question as to whether that is voluntary. I mean, surely that is stretching this matter too far. And I'm really hoping that there's going to be further clarity that is brought to light with this. Now, SARS does have a guide to the understatement penalties, and of course, they've got their guides to the Tax Administration Act and the VDP process and so on. But it is very concerning that they took it to this degree. But it's not just this in isolation, it's also this matter of, was there actually a disclosure? So you've got to read the two together in terms of this judgment. And this judgment was saying the fact that you had already told SARS a year before this, you'd already asked them, hey, I brought this aircraft in and I didn't pay a VAT. Is that a problem? And SARS said, yes, it's a problem. You're going to pay penalties. And then a year later, you're going to apply for the VDP. So they were saying that it's actually not voluntary, okay, because SARS already knew about the default and had warned about penalties and interest. And it was because of the fear of penalties and interest that they then went ahead and applied. So on that basis, they were saying it's not a valid VDP application. So I think the takeaways from this is that if you have a situation with a client who potentially looks as if they are in default and they need to make use of the voluntary disclosure program, don't phone up SARS and ask them for their advice. All right, you need to rely on reputable tax practitioners and good legal advice and go ahead and apply. Because as soon as you ask SARS for advice, SARS now knows about this. It's no longer a disclosure. You're no longer telling them something that they didn't already know. Okay, and then of course your motivation for applying is not because you're scared of penalties and interest, it's because you want to become tax compliant. Okay, all right, so I think that is enough said on the various cases. It does bring me pretty much to the end of what I want to discuss today. We still have a few minutes. So you've all gone terribly quiet. I hope you all did have some coffee during the leg stretch. I'm a bit worried it's all gone. So, oh goodness, yeah. All right, I hope I can read very fast. CGT question. Okay, company, gosh, this looks very complex. I think we might have to take this offline. It looks very specific as well. Let me just ask if there are any other questions in the meantime while I sort of apply my mind to this one. And I'll see if I can answer it now. Otherwise, we might have to just take it offline. Let's look at Ati's question. The 2 21-day periods for revision of tax returns is done in terms of what section in the TAA? Revision of VAT returns. Ati, you've got me there. Can you maybe tell me what that relates to? I think, are you not confusing with the 2 40-day periods with the revision of a tax return, auto assessment? I'm not sure what you're referring to there. But it could, yeah, no, I'm not sure, Ati. I think you might have to be a little bit more specific for me, sorry. All right, Ian, back to your question. So we've got here a company with a secondary listing on the JSE. Okay, so it's a dual listed company. It's a foreign company. It's a dual listed company. And it's got its domicilium in the Netherlands. Okay, the company has issued no statement on the CGT consequences and apparently regards the migration as a change of name. Okay, but they've migrated from the UK to the Netherlands, so they were not resident before and they're still not resident. It's just that it's a foreign company that is dual listed on the JSE. And then it goes into the BHP group. And I think we're going to have to take this one offline a little bit. This is looking very complicated to me. So let me not make everyone sit here while I stare at the screen. I think we'll take that one offline. Okay. If a taxpayer indicated on the ITR 12 that they would be non-residents, do they still continue to file a return? So if they were resident at any stage during 2022, then they would have to submit according to the normal guidelines that I gave you there. And if they're non-residents, you say no income earned in SA anymore. And I suppose that also means that they're not carrying on a trade through any permanent establishment in South Africa and so on. I'm just quickly scrolling back to what we had said around the submission of tax returns. So you're saying here that they indicated on the ITR 12 that there'd be non-residents for 2021. So throughout 2022, they have been non-resident, I assume. Okay. So then you're subject to these rules over here for non-resident natural persons. If they were non-resident throughout 2022, then you're talking about these rules over here, Sam. Okay. I hope that does answer that question. Okay, are there any other questions anybody would like to raise? I must just also caution that I don't provide advice. And so, yeah, I'm just a bit concerned that this one's starting to look like advisory. I don't provide advice. These seminars are intended for information, not advisory. Okay, so yeah, just to make that point as well. Okay, another question. Okay, Ati, let's have a look at your thing again. So we got after filing a VAT return, you offer 21 days to correct, thereafter a further 21 days. Okay. Yeah, I actually don't consult Ati. So if I did give you advice, it would be for free and it wouldn't really be advice, just guidance. Okay. Guidance in terms of the legislation and not giving you specific advice. All right. So you're giving this to me in bits and pieces because in the meantime, I've deleted your previous questions. Just go back to what you had said before. Oh, in terms of what section of the TAA, I'm going to have to look that up for you, Ati. So again, I think let's not keep everybody on hold. If anyone has it quickly, you can tell me, but otherwise I'll have to go and look it up. So I'll have to look up the question for Ati and just see if I can help Ian. Otherwise, for the rest of you, I'm going to basically wind it up. And unless anybody else has any other questions. Okay, so we're just looking at the specific provision around the 21 days with the VAT return. It would be related to an additional assessment, but I'll find the specific provision for you. Okay, but otherwise, I'm going to just say for everybody else, just to say thanks very much for joining us and just to let you off the hook. So I'm sure you all got important things to do, hopefully not to go out and rush through the traffic, but just to say thanks very much for joining us this afternoon. And it's been a pleasure. being with you once again and wishing you very good luck for the filing season. I hope it all works well. Watch out for those auto assessments and good luck for it all. Thanks very much. All the best to you. Goodbye, everybody. Cheerio.
Thank you, Jackie. It's a very interesting afternoon. I'm sure people gained a lot, and your certificates will be on your way. If you need anything, pass certificates or anything like that, let me know or let Danny know. Any questions, I presume we can forward on to you, Jackie, if there's any question that needs answering. And that wasn't handled today. And so again, to everybody, thanks for attending. Thank you for your support. And we look forward to seeing you in the future. And those of you who are avid watchers of the Tour de France, now's the time. They're running into the last hour, so look good. That means I was concentrating on you. I only just tuned in.
Yes, Dan. I wouldn't blame you if you were watching the French countryside instead. I can fully understand that.
Yeah, with a glass of French wine or French bread.
Okay, but now I just want to clarify, if I want to send replies to Ian and Ati, can I send them to you and you'll pass them on?
Send them to Danny, yeah, for sure.
Okay, cool. Yeah, okay, great.
I'll pass them on.
Yes, okay, all right. So what I'm going to do, because I suspect that when you close down the webinar that I might lose this, so I'll just take a photo of these and then I'll send those answers through. Yeah. Okay. All right, Ian and Ati, I'll get back to you on that one. Okay.
Perfect.
Thanks a lot.
Okay, thanks a lot. Good night, everybody.
Okay. Cheers, everyone. Bye-bye.
Cheers.